Oh, look at that. We've got some movement in the futures right now. Not huge movement if you step back and take a look at where it is, but this is more than normal. Not a ton of volume yet, which is to be expected. It's the weekend. There's not going to be a whole lot of volume when fewer people can trade. So we had one hell of a week this week. I don't know who was there for my Wednesday stream, but we had the Fed meeting. I've been preparing for this for quite a while. And I wasn't ready to make a trade, actually. I didn't like the way the market opened up. Everything was super green because Apple, Amazon, Google, Chipotle, all these companies reported great earnings in the morning, which pumped the market. There was still the fear of the Fed rate announcement, and I think if those earnings had come out on a day where there wasn't a Fed announcement, things would have been a lot greener. But there was still some worry, so people had to get out of those gains that they were getting for those morning pumps. But that also probably led into the Fed's decision. They'd already made it at that point by the time the earnings came out, so there's not much they can do. But as I was saying before, everything bullish is bearish and everything bearish is bullish. However, we're starting to come into a point where that's not as true anymore. So the Fed came out and basically said, we're in line with everything you think. Again, that's exactly what happened in the last meeting. Exactly. And the same result happened too. So let's go over the futures real quick, and then I want to pull up the chart and show you what happened because it was important. Also, I made a trade, did pretty well. I got 25% in about 15 minutes, which is very similar to what I did last time. I mean, I made a lot more last time, but still, that's not bad. Making any kind of a gain, if you're making even 5% in like 10 to 20 minutes, that's not bad. That's really good. I mean, if you're using a little bit of money, it's not really going to seem like that much, but you have to think in terms of percentages most of the time because it's very difficult to assess the dollar amount when account sizes are so different. You know, somebody that's got $1 million is going to have 5% for them is insane, whereas if you're trading with 1,000 or a few hundred, 5% is nothing. But for me, 25% wasn't bad. I used a good amount of capital. My cash has dwindled quite a bit, actually, so I didn't use as much as I would have liked because I always want to keep some on the side in case there's a problem. I never want to blow the account up completely, which does hold me back. I admit that. Not using as much cash as I feel I should sometimes does hold me back, and it is a little frustrating when your gains are smaller than you think. Like this time, I went with a different product. I went with the TQs instead of the Qs, and thinking, oh, it's 3x leveraged. It's going to move a lot more. Well, it really didn't because I bought contracts too far out of the money. This still went up and it did pretty well. I mean, it was a great trade, but if I had traded the Qs, I probably would have made 2 to 3 times as much. And I would have been closer to the money. I mean, it would have been a little bit more dangerous. Part of the reason I stayed out so far is because that ETF is 3x leveraged. See, options are already leveraged. And if you had 3x leverage on top of that, that means your losses can be huge if you're putting too much money in, which I didn't want to do. So I went with a little bit farther out strike and didn't quite make as much as a result. But you know what? Playing it safe, making money, that's the name of the game for me. That's what I do. Oh, we got to look at the futures and see where they are, even though they're all going to be exactly the same like they always are. So the S&P is down a little bit, a little more than normal. This is more volatile than you would normally see, and that's not surprising considering we had the Fed meeting on Wednesday. Right here, oh, look at that. The NASDAQ is relatively flat compared to where it was. That's kind of interesting. The Dow, and that is down a little bit, but not too much. Let's see what crude is at. Down a little bit. We're down below $100. So that's kind of a big deal right there, actually. It's been over $100 for a while, and that's kind of been the point of resistance to get to is that $100 mark for oil. And oil is basically the thing we're waiting for right now. Like everything has a problem, yes, but oil is the driver of a lot of these things. Let's see, the last thing we're going to look at are bonds here. Not really doing much. And then cryptocurrency. So let me zoom in on that. What are we at? We're at 23.6, just a little bit below 24, which is kind of where it's been holding. You can see it hit that peak a little bit ago, dipped below and came back. If we look at this trend, though, it is somewhat upward. If you go going back the past like 2-3 weeks, I don't know where here or here, you can start at either point. It's kind of on an upward trend. There's been a little bit of positivity in crypto. Not really anything that matters because there hasn't been a level change. ETH is up a little bit. It's at 1,700. ETH is actually doing a lot better than Bitcoin right now. ETH is kind of the one to beat. Not that long ago, it was down there at 900. Now it's all the way up at 1,700. In fact, it was at 800 before that, actually. I think it dipped into the high eights. I'm not sure. This chart doesn't go any farther back, so I'd have to look at it on another page. But it's been doing really well, and I think that's because there's so many use cases for ETH. Well, Bitcoin is trying to be more of a currency, but Ether is going all over the place. I mean, there are smart contracts. There are all these projects being built with ETH. You look at these games people are playing. Those are built on ETH. Useful programs, apps. There's just so much that you can do with ETH. So it's looking up too. In fact, the next time we have a pump, I can see ETH having much more focus than it did the last time, because people are now understanding that the crypto market actually does have use. I mean, your average person originally just thought, oh, it's a digital currency. Everything's a digital currency. It's just fake. You know, it's like, what, like fiat isn't fake? I mean, everything we do is fake in this economy. What are you talking about? Oh, cryptocurrency's fake. Of course it's fake. That's how you get an economy going. That's how you make something happen that's easier for everybody. You make a fake currency, so if shit really hits the fan, you're still okay. But yes, it's also a way to democratize money so that a minority of people can't make decisions financially for a majority of people. That might hurt them. That was the whole point of cryptocurrency. People just thought, digital money, whatever, it's a fad, right? Like the internet was a fad in the 90s. Oh, the internet's dead in 2-3 years. Like the most useful thing our species has ever invented is dead in 2 to 3 years. This is the mindset of most people, right? So this is why I say implied volatility is always overstated. I love that saying because it's true. People always think things are worse than they are or better than they are. Like 2021 was an example of people thinking things were better than they were. That's why we got that huge bull market. And right now, everyone's thinking everything's worse. We're going to die because we're in a recession. Everybody's dead. So you can see that I believe this would have been the Fed meeting because this was that first squeeze right here. Everything going into the Fed meeting was very flat. So if I back up, you can see right here, it was kind of hitting a top. Every time it came up to there, it would bounce it down a little bit before the Federal Reserve made a decision here. Oh, sorry, I missed you there, Salome Fishby. I like Basic Attention Token. It's pretty stable during this bear crypto run. Yeah, I like that too. I actually got set up with Brave Browser, and I haven't finished getting everything going to do their creator program yet, but I downloaded it, installed it, kind of took a look at it. I actually like the features of Brave in general, so even if I wasn't producing content, I would still probably want to use it. But yeah, any cryptocurrency that's useful is worth looking into. You know, that's why I think it's not, you don't just go and buy random things, because I want to know what it actually does and if it has a use case and if it has a reason to survive a bear market. And, you know, bear markets are very necessary. They crush the things that are worthless so that the things that are good can flourish. I mean, it's the same way with nature. You know, some plant will take over an entire forest or something. It'll strangle out all this other life, and, you know, it'll be a problem. And then eventually some condition can come through that will cause that thing to die back, and it'll allow everything else to bloom again. Image is huge in the crypto world. Look at NFTs. That's all about the image. You know, like there's a use case for NFTs. And if you think about artists and wanting to be able to sell your work without having to go through, you know, the gatekeepers that always used to be, yeah, NFTs and cryptocurrency are a great way to go. And I think they're going to democratize that. So what I was getting to here was the Fed meeting was the big event this week, right? We had so much. We had the GDP numbers. We had a massive amount of earnings. We had the Fed decision. And here's the thing. The numbers were in line with what we thought. We're in a technical recession, but the fundamentals are still strong. So here's the point where you see all the pundits arguing about how bad the recession is going to be and why this is going to be worse than 2008. That's always what they say. It's always worse than 2008. I'm so tired of that rhetoric. Every single cycle, it's the same thing. The bull markets never stop. You got to get in because it's never going to quit going up. And then the bear market's going to be worse than 2008. It's always 2008. Is it possible that things could be worse than 2008 at some point? Yeah, but a lot would have to happen. Because here's the thing. I've said this a million times. The market is forward looking. So you have to think about that in the sense of what is the market pricing in and what level does it get to when it is priced in? And that's what we're looking at right now. So before events happen, the pricing in of things usually occurs. It gets to its fair value somewhat. But there's tension because there are short sellers, there are dip buyers, there are people waiting on the sidelines, there's uncertainty coming up. So the fair value is only for the time being. But once the event happens, if everything is in line with what people say, then the market is going to find the price that is fair. However, things went well. Everything was exactly in line with what we thought. That outlook in line meant that the market was relieved. They had brought things down to what the lowest amount would be for the economic data that came out, right? So the Fed is saying we're at the most, we're going to jack things up to like 4%. That's on the high end of the estimates right now. It's not the main estimate. It's more towards the top. But that's what the market says. It's like, okay, we have a range of things we have to price in. So let's price in the absolute extreme. That way, if it's not that bad, we go up. And if it is that bad, we don't go down that more. And that's kind of what the market's trying to do right now. So you can see right here that we're having a rally, but that is mostly the release of the tension from the buildup before the Fed meeting. Now, that release of tension is a squeeze, it's a bull run, it's a dip buy, it's all those things rolled into one. It's also going to be a repricing because now we have the actual data. Before, the market was just estimating what it thought the market would be later. Now we have a better idea of what it might actually be, so there's going to be some repricing. So first we have to let out the tension, all the short sellers, everybody else that was way too bearish, and all the people that were on the sidelines and coming back in. Then it'll settle back to the price that is actually fair before moving on as the stock market normally would. Right? So you've got this big event, you've got an upwards downwards movement to kind of settle. It's like a wave. And then once it does, the water is nice and clear and we can start climbing again. That's what people want. People are bullish. I mean, the market is not the same as it was in 2008. The underlying fundamentals are not the same. Even though the consumer sentiment index is a little bit lower, people in general still think that the market's going to be okay. I see a lot of negative talk, but I don't see as much, I don't ever want to see the stock market again. There was some of that. In fact, when we were getting to our lowest points, like when we saw this huge negative drop right here for 2-3 months, whatever this was when people were saying they didn't want anything to do with the stock market. And then down here, the same thing was coming out, which is to be expected. When things are at their lowest, people are their most bearish. People think that this is going to continue because psychologically it feels like that. You know, it's like if you're boxing or something and you're just getting punched over and over and over again and you can't punch back, you're going to feel like the fight's impossible and it's done. At the point that you're the most negative is the point when the other team is probably getting overconfident, where you might actually be able to turn things around. But your negative mindset is going to hold you in that corner. So that's what you have to think about in the market. Is my mindset affecting my outlook? Because things have gone up or down for a long time, is that making me think things are different than they actually are? Is that clouding my vision? Because yes, a trend will exist. And right now we're in an uptrend. We have been for a couple of months. It's been a very volatile uptrend, but because of the Fed meeting release, the tension release, we've now been able to come up to this 4,100 level, which is kind of about where we were thinking. If I have the volume profile, you'll see that volume starts to pick up right there. See right here, this is the level that I've been talking about for weeks, right? There is nothing in here. So you can see why when we squeezed so quickly. I mean, these are weekly candles. So let me switch this to the daily so we can get a little bit of a better idea here. The daily is going to show us the meeting, which weekly is usually good for long-term trends. But in this case, we want a short-term trend because we're looking at specific incidents that happened during the week. And that would be the Fed meeting. So you can see how volatile it was. So here's the bottom 2 contract cycles ago. The bottom, and look at what day it was. It was the very last day of the June contract cycle. That's exactly what happens. It ends up changing directions on a new contract cycle because things are being readjusted. And the June one right here, this would have been the end of the quarter. So this would have been triple or quadruple witching and everything. Everybody's trying to reposition their contracts because the new cycle starts. So they need to be out of the ones they don't want to hold everything for, and they need to be in the ones that they want to start moving for the next cycle. And look at that, boom, gapped up. Because there's just a whole bunch of orders. People were starting to feel a little better. You look at how many red candles are in this last cycle. There are very few. There's a lot of green candles in the next cycle. But it was coming up to a point and rebounding every time. This was resistance. You can see it was support down here before it came down, which ends up becoming resistance when you're going the other direction. That's because that's where shares change hands. That's where people decide they want to get in and out. And that's where stop losses are. I was talking to somebody about stops, which are important if you're using large amounts of money and you're not sure about yourself. If you don't follow your plans very well, then yeah, stop losses are very necessary. But at some point, I mean, this gets into the conspiracy theory realm a little bit, but it's not really, if you think about it. People talk about stop hunting. It's not really as big as people think it is. Like somebody putting a $20 order in and a stop loss is not what the people are looking for, but they're just saying like the collection of stops end up being here. And that this is a psychological level. It's not because this is special in any way. It's just because people see this and they make it a self-fulfilling prophecy. They see, look, this is where it was bouncing multiple times. So I'm going to use this as a chance to make my entry or my exit, which is what they did. And when it came up to that point, and there wasn't enough pressure to go up, it bounced off. So why wasn't there enough pressure to go up? It was coming up very strong. Why didn't it just keep going? Well, because of the uncertainty of the Fed. That was the pressure pushing down. See, we have these events. The reason I talk about the Fed so much is because it's the most important thing in the market. The Fed is what drives everything. I mean, it doesn't have to. I mean, there are so many other factors that actually go into the market and the economy in general, but the Fed is the driver for a reason. It's supposed to stabilize prices. That was the whole point of creating the Fed back in 1914. They thought all these panics, there was like a panic in 1897 or something like that, a huge one. There were a few other ones, and people just got tired of it. They wanted some more stability. So the Fed came in, and, you know, obviously that worked so well. We've had perfect stability, never had a problem since then, right? No. But it does help in some ways for the little stuff, right? The big stuff, you know, it would people were going nuts with speculation and all these weird new rules were coming up, and people were trying to make more and more money with shadier and shadier, riskier deals. Yeah, then problems happen. And the Fed doesn't have anything to do with that. There's nothing they can do about that. That's all the United States government or any government that is dealing in the economy. They have to put limits on what people can do. The Fed can only say, all right, we're going to change the availability of money. We're going to change the amount of supply in the market, and that should change demand, which will move inflation or anything else up and down. Supply and demand, the very basic concepts. That's what they're working in. And that's what you see right here in this level. You see a supply and demand change right here. When things get up to that point, there is not enough demand. There's way too much supply. People want to sell. They're getting scared because they're like, oh, I bought down here. I'm up here. There's a top right here. I need to get out of it. And it ends up being self-fulfilling. But there would be pressure beyond that if there wasn't an event coming up. But as we know, there was an event right here. And now that the pressure's been released, you can see this. I mean, if you were to blow something up, it would just go straight upward like that. And that's exactly what we had after the meeting, because there is a ton of upward pressure. Now, that's to be expected right after the meeting, especially in this little area of low volume right here. We moved right through it. You can see one day just kind of crushed it, and now we're getting into the area where things start to get a little heavier. The moving averages are here. This is the daily. If I switch it back to the weekly, you can see that the weekly moving averages are going to be coming into play a little bit, and those carry a little bit more weight right here. The 100 and the 21 are kind of crossing. So this is a little bit of a weighty spot. You can see there is some support and resistance here. This area right here is an area of resistance, an area of support. We'll see what happens when it goes above it, if it goes above it. So that's the question. We've had this release of tension. The numbers are in line with everything. The Fed is in line with the market. So now we have the ability to go up. So I saw a clip from Mad Money, which is a show I highly recommend not taking a lot of advice from, right, on any specific stock. So if you watch a show like that or any financial media and they talk about a specific stock and it sounds really good, be careful of the FOMO. Try not to get sucked up into that. However, sometimes there's some good information on there. Like the information that they give about long-term investing, I think is actually really good. Putting your money in an index fund and using a little bit of it to trade, that's the exact same philosophy I have. So I completely respect that aspect of the show. However, it's still pushing its own agenda. So you have to make sure you know that when you see it. But there was actually a really good clip.
Buy. But everybody knew that 75 basis point rate hike was coming. The surprise yesterday was when Fed Chief Jay Powell made it clear that he's willing to pause and see how much the economy's weakened before he decides to slam the brakes on it again. He's going data dependent, which is exactly what the bulls like, and allows them to trample the bears. Yet this morning I listened, frankly, flabbergasted. I listened to analysts and managers telling people that we're now going into either a severe downturn or worse, a period of stagflation, which of course is the kiss of death of stocks. These so-called experts could not have been more negative, repeatedly hammering home that we're now in a recession. A technical term that gets trotted out whenever you get 2 straight quarters of negative GDP growth. So therefore, stocks should be sold and sold aggressively. Sell. And worse, this is a recession with high inflation. Oh, that's a total nightmare we haven't seen in decades. Get out now! I said I disagree with all these naysayers, and you had to buy, not sell stocks. Take the other side of their ill-advised trade. But one advantage of being an ancient mariner is that I have seen so many cycles that I know when the Fed says one and wait, when the Fed's signaling that we've already taken the tough medicine that we need, you have to realize that you're no longer fighting the Fed when you buy stocks. What we heard from Jay Powell yesterday was extremely bullish, not bearish. How about stagflation? Other than the late 70s or early 80s, it's never really happened. Now, back in August of 1988, I experienced my first bout of stagflation worries. I was running a small hedge fund with my then wife, Karen Kramer. I had worked all week on my negative stagflation thesis. Oh, I was so smart. And I presented it to her. She listened. And then the next morning, she put every single penny of ours to work, buying stocks hand over fist. And then she borrowed about $50 million from Goldman Sachs on top of it to get even longer. I was furious. When I got back, I said, what gives? Simple, she said. You represent the conventional wisdom, Jim. Everyone's saying the same thing, and therefore that thing would probably be dead wrong. Sure enough, the stagflation scare disappeared about as quickly as it came, and our fund made a fortune in about a week's time. That's what happens when everyone gets negative about something that's entirely chimerical and theoretical. When the Fed gets out of the way, you have a real window. You got to jump through it. That's what happened today and yesterday. Today, when the averages exploded, aided by the recognition that we could be in a recession. That's right. If a recession really has arrived, that's actually good news right now. Many commentators are too young to remember that when a recession comes, the Fed has the good sense to stop raising rates. And that pause means you got to buy stocks. It has always meant that. Always.
The part that you probably didn't hear because the audio was crazy was that he says the Fed is allowing people to buy stocks. That's the basic point of this whole thing. The Federal Reserve did what they did, and now they're kind of taking a little hands-off approach because they want to make sure that everything's okay. They want to see what's actually happening in the market. See, everyone else is rushing to snap judgments. They're just sitting back and they're waiting. What they're doing is they're saying, all right, we front-loaded everything. We put the pain in there quickly, so hopefully when people adjust to it, it won't be so bad later. Because you think, oh, maybe you want to ease them into it and just go a little at a time. Hopefully everything will work out better that way, but not always, because sometimes easing into it just means you're sustaining the pain for a longer period of time. Yeah, maybe the pain isn't as extreme, but sometimes a dull ache that lasts forever is way worse than just a quick Band-Aid rip. That's what they're trying to do. They're trying to rip that Band-Aid right off and then see if everything heals and goes back to normal. And that's what I think is going to happen. I mean, if we stay at the current level of news, basically meaning if we don't have some new catalyst to make things worse, then we're going to have a bounce probably right now. I don't necessarily know if this is going to be a bounce. Like next week is going to be the test to see if that's what happens. People are very sure that it is or it isn't. I'm not. The end of the week was kind of an indicator that it'll probably bounce, but at the same time, these rallies get crushed a lot too. The thing is, even though the Fed's stepping out of the way, they still have raised interest rates, and people are still going to have to feel that who borrow money. You know, people who are looking for mortgages are still, so it's still going to put pressure on prices, but the market is going to look at the future and think, okay, this pain is all going to be in the short term, and it should make things better in the long term. And if we don't have any other problems, then it probably will. So that's the point. Even this guy, you know, it is completely ridiculous. And I know he feels like an idiot going out there and hitting those buttons and stuff like that. But at the same time, sometimes there's a little bit of good information in there, like that right there. Everybody's going to be really bearish still, but the market actually doesn't look bad. And what's funny, look at this. Right now, people are freaking out. The currencies, if you see up here in the top left, those are all negative, right? We look at the futures that I put down. I can bring them back up. Those are negative. You know, so there is a little bit of fear going on right now, but it's not anything to worry about. So we're not seeing too much fear right now, just because everything is looking better and the shorts are getting squeezed. So people are looking for a bounce. But the question is now, how long is this bounce going to last? That's what we have to look at. How high are we going to go with a bounce? And is it a bounce, or is it the continue, or is it a new rally? Because that is a good question, actually. I mean, I still think there's some more downward motion to be squeezed out of the markets, but I don't know if we're going to be able to get that before things clear up. If we have a little bit more downward motion, that would be extremely bullish in the long term, because you really have to have that one last explosive exhaustion of whatever big move you're having. That's what we had at the end of the bull market. If you can see, right before the Fed announced things, we were kind of having one last little go, and, you know, volatility picked up from the September area and on. But once the Fed said, hey, we're going to start doing rates now, we're having the talk about the talk, boom, that just stopped the market in its tracks. And even though the decline started on the first day of the year, or maybe even the last day of the previous year, I don't have the line marker on here to show me, there still kind of was some preparation for it right beforehand. And this would have been a couple of months of the market being uncertain and only coming up to this, 4,700 level. I mean, there was that peak for a couple of weeks up there, but mostly it was just sitting there. So we've got resistance up here where things were uncertain, and you can kind of see that the support for this area was the resistance for these areas over here. So this is definitely an area to look at, because you can see it's really close to this volume, this high volume candle. There's a lot of support. There's a moving average right here. Which moving average is this? This one's the 50. I like the 50. The 50 is actually one of the more important averages. The only ones I use are the 21, which a lot of people use 20, but I like the Fibonacci thing. So the 21, the 50, the 100, and the 200 is down below the screen right now. Those are kind of the main averages that you would see across technical analysis. There are going to be tons of other ones. People say like, oh yeah, the 8's crossing over the 13 or whatever, but that's getting a little too intense for me. I'm thinking more long term. I'm thinking more swing trade, so I don't really worry about that part of it. There's a lot more weight when you're thinking long term. See, people that are thinking intraday are not getting the amount of volume and the motion from the trend if they're thinking short term, because they're going up and down with the daily motions of smaller volume. But when you're thinking long term, you have the big investors. You got the Warren Buffetts out there doing that. I mean, the Warren Buffett is looking at things on yearly, decadely timelines. He's thinking about how is this going to perform throughout the next decade. Whereas traders are thinking, how is this stock going to perform throughout the next 30 minutes, maybe even the next 5 or 10 minutes? And that's not going to get you anywhere. So the question is, where would a top be? My guess would be somewhere around here. Right, we've got up here where the moving averages is, like the 50 would be. This area is a good place for a top here because there's been a lot of shares changing hands right in there. You can kind of see how it's forming support and resistance line. There's also the peak. We could get all the way back up to the peak again. I would not be surprised if we rallied that hard now that we have a lot of the stuff priced in. The question will be, though, what are the next economic numbers? So we have 2 more numbers, I believe, before the next Fed, like in the CPI and the PCE, which are both measures of inflation that are similar but a little different from each other. Those are going to be the important ones. We're not going to get GDP again before the next Fed meeting, I believe, because I think GDP comes a little later. But that's what they're going to look at. They're going to be looking at inflation. Is what we're doing actually working? Is inflation coming down? Because they know it, we know it. It takes time. That time is now upon us. Early in the year when I started the broadcast, we had a slew of rate hikes ready to go. They told us, all right, we're going to start a little bit, and then we're going to see what happens and go from there. So they started raising rates a little bit. That didn't really do much, so they slammed them up harder and harder down here. And that's what we said. All right, we got a meeting in May. We got a meeting in June. We got a meeting in July. We've got earnings coming up. There was the earnings season that we had back here. There were so many things that were moving the market and so many things we were looking at until we got to the sit and wait points. But now we're there. It's been months. I mean, I pulled out charts. I said, look at this. 2 months from now, we're going to be in a sit and wait period. And that's when things could turn around if they're going to turn around. Although things could continue to go down. So that's what we're waiting for. If the economic numbers come back around where they are now or lower, that will be bullish. If they come in higher, that will be a surprise. I mean, maybe the first one could be higher, but it will be a little bit of a surprise if they come in higher, and that will tell the Fed, guess what? We're going to have to continue this tightening. So if you see numbers coming out that are high, the market is not going to be happy about that. That's one thing you can basically count on. If you want sure things in the market, you can say that if inflation comes out higher on the next CPI or the next PCE, then the market is going to drop. If inflation comes in somewhat in line or lower, then that could be bullish for the market, or it could just trend sideways. But that's what we want to see, because these things take time. Has inflation peaked with this last number, this 9.1 or whatever it was? I forget the exact number. If those things end up being up in the future, that's going to be negative for the market. So that's what we're waiting for. So we basically exhausted the meetings. We don't have another meeting until September 20th. That's going to be another important meeting. And then after that, there's only 2 left. There's November and December, and the November meeting, I think, is a minor one. So they might hit it really hard in September if things haven't slowed down. If things have slowed down, then they might slow down with their rate hikes or stop them altogether. So the slower they go, the happier the market's going to be about it, because that's going to eventually lead to a reversal, hopefully. They want to bring rates back down so that things can continue the way they were. But what their neutral rate is in the future, I don't know. That's the interesting part. We'll have to see what happens with inflation before they decide what the neutral rate is. Because right now we're going into restrictive territory on purpose. We need to slam things down, and that's expected. But once things have been fixed, where do we go with rates? Do we bring them all the way back to zero? No. They don't want to do that. They need rates to stay up enough so that way during the next crisis, they have something to pull down. That's one of the things that saves them. It's not the biggest thing, as we learned from the 2020 crash, but it is important. So they want to have some ammunition in the tank, and that's what they're doing. They're unloading their balance sheet so that next time they have the ability and the space to put more assets on there, and they're jacking rates up so that they have something to pull down during the next crisis. I mean, that's what they're thinking. Like these crises happen regularly, so they need to be prepared. And the only way they're prepared is if they have space on the balance sheet and they have space to drop the rates. So we talked about the Fed. Very important. It was a great week. I made a little trade on that. I'm going to get to that here in a sec, but I want to go through my main points here. The other thing we have going on right now is earnings season, and I've got a few companies that I wanted to take a look at. I made a trade on a couple that went pretty well, actually, so we'll get to that in a bit. The last thing I wanted to talk about was GDP. We said, hey, we're in a recession now. What is a recession? 2 consecutive quarters of negative GDP, which is what we got. Q2 GDP came in at negative 0.9%. The estimates were at positive 0.5%. The prior was 1.6%. So not as bad as Q1, but still negative. So we're in an official recession. However, spending is good. Employment is high. Everything is still on track fundamentally for the most part. A couple of things aren't so good, but most things are. So that's the thing you have to keep in your mind. When you see all this stuff about the economy is in so much trouble, everyone's going to be so hurt by this recession, you have to remember, as of right now, nothing has really changed. We've just kind of slowed down a bit. If you look at progress of a society over time, it goes up and down. And GDP is kind of measuring that for our output, our goods and services output. It goes up, it goes down, but it stays in a trend line, and the trend line is still up. Even though we've had some drops recently, that leaves us room to expand when things open up more. And the big reason we have those drops is because of the shipping problems. If you can't produce more than you were producing before if your ability to move those goods is diminished. And that's what's going on. We're able to produce goods, but we don't have as many materials as we need because things are backed up. We also don't have the ability to send goods that we do have to the places that would make it the most profitable. So it's impacting GDP in a, I don't want to say a non-fundamental way, but in a way that once it's cleared, everything else will just go back to being what it is. I mean, we're like a condensed spring ready to spring right back up. So GDP being negative does not worry me right now. It's not as negative as it was before, and the estimates are going to be lowered now. IMF lowered global growth for 2022 down to 3.2%. They also downgraded 23 outlook to 2.9%. Basically, the IMF downgraded global output, which is to be expected. Yeah, things are backed up. We're not able to sell as much. We're not able to produce as much. Of course, things are going to be down, but it's not because of fundamental reasons. Like, we haven't had huge bankruptcies that destroyed entire sectors of the market and made it impossible for certain goods to be made. No, we just have backups that are basically man-made. You know, it's not like a comet came down and destroyed stuff. We just shut things down as a global society. You know, some places more than others, but we still did it. So once we clear the man-made hurdles, things should be fine. Like, war is also a man-made hurdle. We don't have to do that, but Russia's doing it anyway. And they said they're on track to meet their strategic operations on time. That also means that maybe this thing will be over sooner than we think, which is a huge relief for the market. That's the other big thing. Like, the Fed was kind of weighing on anything, but now it's stepping out of the way, and we're back to inflation in Ukraine. But Ukraine is old news now. You notice we're not talking about it as much. A lot of other things are coming up, and a lot of that has to do with the fact that we have an election cycle going right now, and the whole Ukraine thing has just been in people's minds for too long. You know, people only will focus on something for so long. It doesn't matter how bad or extreme it is. That thing will only be in the public eye for so long. That's kind of what's happened with Ukraine. That's kind of what happens with a lot of things. And there are some stupid news stories that I can't wait to go away, but we'll see. We'll have to see. So let's get to the last of the numbers here, and then I can start getting to some of these trades that I made. So we talked about GDP. It's down a little bit. No big deal. That's why I played End of the World music coming in, because people think it's the end of the world. Let's see. The PCE, which is the Personal Consumption Expenditure Index, headline came out at 1%. The estimates were not listed on my paper. Crap. Previous was 0.3, but it's up. So it was above the estimates, I can tell you that. Here we go. Oh, that was month over month, so year over year. So the PCE year over year was 6.8, and the estimates were 6.7. That's not too much different, really. That's not that big of a jump over it, but it is over, so you got to take that into consideration, and the Fed did. But that was headline. So core is up 6%, or 0.6%, and the estimates were 0.5%. year over year. That was month over month. So year over year, core is up 4.8%, and the estimates are 4.7. So really, it's not that much above the estimates in core or headline. It's the same. Just it's 0.1% higher. That's not that much. So I'm not considering that a reason to panic. The next thing we have is the University of Michigan consumer sentiment is at 51.5, which is above the estimates of 51.1. Prior was 50.0. That was when we were talking about how negative people were on the market. So in the past month, people have become slightly more positive on the market. And you can kind of see that in the chart. I mean, a month ago, we were somewhere in here and people were very negative. And then boom, we move over to here and people are a little bit more positive because things are looking in line. But that's what we're waiting for is that data. So we've stepped out of the Fed has stepped out of the way and now it's all data. The other thing that Kramer said in that clip was data dependent. That was the other reason I wanted to play that clip. That's an important term. You have to remember. They're data dependent. They're looking at the actual data. They're not paying attention to the hype. They're paying attention to what's actually going on, which is what they should be doing. The media is just there for clicks and views. They're trying to scare you. They're trying to make things seem extreme so that you'll keep watching and keep clicking. The Fed says, oh, we actually have to deal with people's real lives, so we're going to look at the actual data and not the spin. You know, one of my favorite things is when Jerome Powell is in front of Congress and they're trying to ask him these politically charged questions, and he just goes, no, it's not like that. You know, this whole thing, it's like, oh, well, what about this person? He said all this stuff about the economy, and it's like, nope, not like that. Just simple. That's what he says. He doesn't put any emotion into it. He just basically shuts it down because this is all hype. What we're talking about is hype. If you talk to anybody, they're going to tell you about the hype. It's not real, folks. It's not real. All the stuff that you're seeing is the extreme. It's a potential, it's a possibility, but it's not the actuality. It's the top of the range. Look at I love standard deviations. I never took statistics. I didn't like math growing up, but once I got into trading, there's a certain amount of math that you just kind of have to do, and it's not as much as people want to think it is. But something like standard deviations are very important. If you're the media, you're always at the top end of that standard deviation. You're not paying attention to the mean, and you're not paying attention to the low end. You're just paying attention to the thing that will get the clicks, which is that top thing. And that's every political issue we have. No matter how smart you think you are, part of your emotions are geared towards the top of that range because that's just what we've been conditioned to do. So things are not as bad as they seem. The next thing we have, initial jobless claims. They're up 256K. The estimate was 253, so to me that's roughly in line. Continuing jobless claims are at 1.359 million, and the estimates are at 1.38. So those were under the estimates by a little bit. And people really aren't talking about that one, right? They're talking about, PCE is a little bit above estimates. Yeah, well, the jobless claims are a little bit below. So there you go. And then new U.S. home sales, they're down 8.1%. Previously, they were up 10.7. So that, to me, I love that. That's important. Housing prices were one of the big drivers. Like, if you think about the problems in the economy, number one was oil, number two was food, and number three was housing, in my opinion. You could throw other stuff in there, but those were kind of the big drivers of the things that were actually hurting your average person. It's very difficult to get a house at this point, and now that rates have gone up, it's even more difficult. If you had a $500,000 loan amount, that will buy a lower quality house than it did a year ago because now you're paying more interest on that $500,000. It's eating into your ability to buy. So that's going to lower the pool of buyers for any individual level of housing and hopefully drive the prices down enough to where they're more reasonable again and people can get loans that they can actually pay back. Because that's the problem. At a certain point, you don't make enough money to pay back a loan. And in 2008, 2007, that was the big problem is everybody was getting a loan. They had a way to categorize people as all being AAA. Loans were rated by how likely people were to pay them back, and AAA was the best. If you were able to bundle a bunch of AAA loans and sell them, you could make a killing. So the way people did that was they just lowered the standards and let anybody who had any kind of money coming in borrow well against their means. Why? Because everything was going up. And if you bought a house and you could barely pay for it, the value of the house still went up and your wages were going up and everything was going up with it. So it just looked like the right thing to do. But in this case, we have the opposite thing going on now. We have fewer people being able to get a loan. We have fewer homes being able to be sold. So that's going to put some downward pressure on houses and bring them to a more reasonable level. Is it going to stay there? No, it'll bounce. I mean, housing will continue to go. If you think of all the most useful assets over time, land and housing are the main ones. Like food is a necessity. Land is a necessity. Those things are going to continue to appreciate in value. But some like random collectible you have right now may or may not be worth money in the future. It really depends. But you know that land is valuable. Because if everything happens, if the market crashes and all your stocks go to zero, well, you just have paper, and that paper is worthless. But if you have land and the value of housing goes to zero, guess what? You still have land. You still have the ability to barter with that land or sell it at a future time when things come back. It's an actual thing that's useful. Like your car is useful, but a stock is just a piece of paper. We're all trading, trying to get money, whether we're saying it's in the long term and pretending, oh, we're investors, we're doing it long term. No, you're just long-term trading. It's the same thing. You're just doing it at a longer time horizon, because eventually you want to take profits. You're not just doing that to watch the number go up and then you die and you go, well, that was fun. No, you want to reap the benefits of that at some point. So you're making a long-term trade as an investor. So you have to have at least some of that in your mindset. All right, so the last thing I want to say before we move on, when you're thinking of GDP, what I found out that was kind of interesting, government spending last year made up 30% of GDP. So that made me kind of think. Every year, the deficit continues to go up, spending goes up, we borrow more and more money, and people always say, hey, this is bad, we can't do this. But if you continue to spend as a government, you increase GDP. GDP has to climb constantly too, because that's how things are measured. It's like, are we progressing? Well, let's look at GDP. And part of that is just the government adding. A third of it is the government continuing to spend more money. So to me, that makes me think, is there an incentive to actually not lower the debt? Is there an incentive to keep it going? I mean, yeah, we talk about the negatives of it and the problems, but increasing it makes our GDP go up, which is positive in the world economy and makes us look better. So why wouldn't people in political power want to do that? So that was just a random thought as I was going through everything. All right, let's move down to the important stuff. Now, the CHIPS Act was passed. It passed the Senate 64-33. It's $280 billion, of which 52 are going to subsidies for domestic semi-production. Now, that's something I've been talking about for a while. That's extremely bullish for the market. If you own tech stocks, specifically semiconductor stocks, or anything related to it, they're pumping now because of this. It was a great day for NVIDIA, for AMD, all those companies. I have a little bit of AMD. I'm glad I bought AMD down there in the 70s. It's been doing pretty well. In fact, let's take a look at it right now and see what we got going on. Oh, look at that over time. It's just so beautiful now. But it doesn't look that good if you're looking at it long term. You think like, oh man, it came down quite a bit. Yeah, it did, but it pumped too much. It needed to come down. It's at a much, much better price now. And it's in an area where there was actually volume to support it. And I bought like right in here. It was like 76, I believe. So where was I? I think I bought it was like towards the end of the day. So I think I bought on this red candle right here, which these are weeklies. So maybe later in that week. And I've been writing it up ever since, which has been wonderful. So that was a good one. The CHIPS Act helped those, which also brings me into something else. The stock ban bill for Congress, their senior staff and their families is coming soon. It's basically going to ban stock trading, but not mutual funds. I want to make that point, right? So you're going to see all kinds of political rhetoric about this, but the big one to me is they can still buy into mutual funds. So it's basically barring them from trading individual stocks, and I would imagine derivatives related to those stocks as well. Like they're like, all right, we can't trade stocks, well, we'll trade options and just make even more money. I'm assuming they're banning that too, but I mean, this is still in the works, so there's not a whole lot of information about it. It's probably out there somewhere, but from what I saw, it was basically just talking about stocks and assuming stock-related products. It would force them to sell what they have now or move it into a blind trust. So there's incentive for them to fight this thing, right? They don't want to have to sell all their stocks. They don't want to have to give up their grip on power and their corruption and the way to make money. Like the example is, not everybody, but most people in Congress are doing something like this. But what you see is right now, mostly Nancy Pelosi's trades. She profited pretty well. I mean, she made more than most of them. There were, I think, one or two senators that made more than she did. But she's the one, since she's like third in line for the presidency or something. Like she's got the important position, so she's kind of in the spotlight right now. She exercised some NVIDIA options right before the CHIPS Act passed. I mean, if you know that's going to benefit companies and you know it's going to pass, that's insider trading, basically. I mean, they're going to have to prove that she didn't do that, and I have a feeling, whether she did or not, it's going to show up that she didn't, right? They're going to just make it look like, oh, yeah, it really wasn't actually. It was just kind of a coincidence and blah, 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 like they always do. That's just how this thing works. But there were plenty more than just that one. There was also the Microsoft trade before the Pentagon deal. So it's not like she just did this one thing. It's like these people are doing this over and over again, and there's a record of Pelosi's trades that are very questionable, which is why she's in the media a lot. It doesn't matter what political side of the aisle you're on. They're both doing it, right? She's the one under the spotlight, but everybody's doing it. So it's not just her. It's not just, don't get caught up in the political rhetoric of, I don't like this person or I like this person. No. They're all doing it. This is just a small sample size of the whole thing. So this act could actually affect the stock market because these people have a lot of money in their roundabout way. They're like, oh, I don't directly have millions, but I happen to have these little shell corporations that are run by my family. And oh yeah, I don't know how, it's not my money. Like, no, it's your money. You're using it in other shady ways. This is what everybody's been doing forever. I mean, we passed the Stock Act in 2012. That was basically a finger wave at them, like, don't you do it. But they could still do it, and they got around it. It's no big deal. So they're trying to expand that and make it a lot harder for these people to trade these stocks and profit off of their political movements. So that could affect the stock market. So you have to watch that bill. Is it going to pass? Who knows, man? I mean, these things that negatively affect Congress people tend to not pass. So we'll see what actually, this could just be a gesture to be like, oh, look, we're trying to clean up Congress, but really we have no intention of actually doing it. We're just going to drag this on forever and then quietly kill it in the middle of the night when people aren't paying attention. And of course, there'll be some other story in the news, right? There'll be the next Johnny Depp Amber Heard case when this happens. See, that's what you have to realize. When you see these big, stupid news stories, look at what Congress is doing, because bills get killed or passed during that time, and they don't get a lot of press releases. I mean, there'll be some on it, just because like, oh, look, we did. It just got covered up by the big stories. But no, they push the big stories so that you don't see the important smaller stories. So I'm definitely watching that, keeping an eye on it. So we also had a, oh man, this is hard to read all this stuff. Inflation Reduction Act, which is to be introduced. It's proposing like $369 billion for clean energy. It's supposed to reduce the deficit by 300. How are they going to do that? Well, raise $739 billion in taxes. What do you know? Like, that's how we're going to fix everything. More taxes. A 15% minimum tax on mega corporations, which they've been talking about for a while. So those would normally be negative for the market, which actually they kind of are in some ways, even though they're somewhat necessary. I mean, you got like these people need to, sometimes companies are able to get around things that they shouldn't be able to get around. I don't think this is going to fix anything, because like everything else, there's going to be loopholes that aren't obvious to the public until later. But the positive thing from that is the fact that there's going to be $60 billion for clean energy infrastructure. Some of that's going to the EV market, some of that's going to solar, some of that's going to other clean initiatives. It's going to extend the 7.5K EV tax credit, and it's going to add new tax credits for home solar panels and used EVs, which is very bullish for any of these EV plays like Tesla, Plug Power, stuff like that. These credits are definitely going to affect them, and the money is going to help build infrastructure as well. So basically anything technology and clean energy is doing well right now, and has weight behind it. I mean, you can look at these companies and they'll probably move up. I mean, companies that you think are stupid and should go bankrupt, they're probably going to be moving up. And when you're looking for stuff to play, when things are when the whole market is going up and you just want something, semis and clean energy are a good play right now. So I'm keeping an eye on those stocks, specifically Tesla. That's why Tesla's up quite a bit right now. In fact, let's take a look at Tesla. I mean, they had that nice pump on earnings, and then let's see what they did. I actually haven't really looked at Tesla in a little while. See, they're doing exactly what the market does, which is to be expected because they're highly weighted in the indexes. Like the SPY is highly weighted in Tesla now. But look at that. They moved up to it, came up to some moving averages. They're kind of in this highly volatile area again, getting up towards the lower volume section. So Tesla is happy right now, which I own some Tesla, so I'm actually happy about that. Not as much as I wish I had, but it's something. And I made sure to get it down in these low areas again. I've been really, it's been really interesting. I somehow this bear market, I've been good at buying these little dip bottoms. I just kind of think like, oh, this feels like the right day. I'll buy a little bit and then go, oh man, that ended up being the day. I should have bought more. It keeps happening over and over again. So they're going to benefit because the market, number one, they're benefiting from the market. And number two, they're benefiting from both the CHIPS Act and the Inflation Reduction Act. Now, assuming the Inflation Reduction Act actually passes, because this is just being worked on right now. And it's kind of a bit of a political sword to wield. So we'll see what actually happens with this thing. But if it passes, then these green energy companies and EVs and things like that are actually going to do really well because of it. The speculation is already coming in. You can see these green candles are part of it. So that was looking pretty good. To move on, go to the other direction from clean energy, so dirty energy, right? So the U.S. is selling another 20 million barrels of oil from strategic petroleum reserves as part of the previous plan to sell 180 million barrels. So it's just on track with what they're doing. I don't know if that actually means that there's going to be more than their 180 or if that's just 20 million of the 180. But prices have been coming down in oil, and the more we add to the market, the more supply we add, the lower it's going to go. And like I said, oil is below 100 now. That's a big deal. So it's been coming down a little bit. Let's see. The EU is renewing sanctions for another 6 months on Russia due to continuing aggression. So that's going to put some more upward pressure on oil. Fresh U.S. sanctions are coming in, so that's a little bit more upward pressure on oil from the Russian side, but not for everybody else. So I don't know if that's really going to push things up that much, but it's something to keep in mind. Now, Russia, like I was saying before, Russia says it's still on track to finish strategic military operations in Ukraine on time, which means that if they do that and that time is soon, that's a huge relief for the oil market. To me, there's not that much upward pressure on oil if things stay the way they are. If something big happens, if there's an oil spill, or if regulations cut things out, or the war extends for some reason, yeah, that could push oil back up. But I think oil is getting to a point where it's consolidating in a range now. We don't have this extreme upward pressure that we've had for months. We kind of have a consolidation phase going on with oil, which basically means the market is going to stabilize a little bit. That's like oil kind of drives the market, and it's been like that for decades. So it's good to keep an eye on oil. So that's the news for oil. Now I want to move on to China here for a second. Just going over things to give you an idea of the broad market, and this stuff is all pretty important. So the SEC chair Gensler says it's unclear whether the U.S. and China can avoid delistings. We've been talking about this for weeks now, for months probably. They keep talking about wanting to regulate China's companies more to basically match the regulation that U.S. and other countries' companies have. But China is a lot more secretive. They don't want certain parts of their information getting into U.S. hands or getting into anybody's hands. So they withhold certain information. And that's not just the companies. That's the government telling them to withhold that information. So we're basically negotiating with the government to be able to see more finances from Chinese companies to make sure we're making good investments. That's the whole point of this thing. Is like there's this big political war going on. Is this giant thing between the U.S. and China, and it's like another Cold War kind of. They're just kind of standing. They're all standoffish, but there's the tension underneath, and we don't need that because average people are trying to live their lives. We're trying to just invest and make money, and what we want to do is we want to be able to see the finances and make sure the company is healthy enough to invest in, because the Chinese companies have more of a reputation. The cheaper ones, I should say, not the good ones. Cheaper Chinese companies have a reputation for being scams because you can't see what's going on. And there have been a lot of scams. It has nothing to do with people that don't like China or this or rhetoric or whatever. It just has everything to do with the data reporting. There's not as much data reporting, so it's easier to get away with things. Luckin Coffee, for example, right? That was supposed to be this huge competitor to Starbucks, and it was going to take over. It was a Chinese-based company. Their stock went from $5 to like 40 or 50. And then it came out that they were fudging the numbers. So it dropped back down to 5 and it got locked. It got halted. I owned it at that time. When it dropped down into the 5s, I was like, oh, I'm going to buy a few shares just in case it comes back up. Of course, this was earlier on in my trading career, and I somewhat early, and I didn't realize at that point that was not the time to get in. That company had some serious problems. I wasn't looking at SEC filings. I wasn't paying attention to the news. My brain was just like, company go up, company go down, company might go up. So I bought some, and I got locked in the halt, which is wonderful. Luckily, it wasn't that much, so it wasn't a big deal. And eventually it unlocked, and the price dropped. I had to sell at a loss, of course, but that's what happens when you do something like that. So the U.S. and China are trying to come to terms so that companies can report in the same way that all other companies do, and we can have the information that we want. So that's what we're waiting for. Is that actually going to happen? And that's part of the tension. So right now, the SEC is basically saying, I don't know. Right? I mean, we've had these there's like a call between Biden and President Xi. There's still no answer on it from them. This thing just seems like it's going to go on forever because China just doesn't want to give out that information. And I don't know if they're going to budge. They might, but I think the U.S. might have to budge in some ways. So we might just have to say, all right, certain things just aren't going to be there. You do it at your own risk. That's kind of what we have been doing for a while, but because there are problems, we want to regulate things, and that's where the big problem lies. Trying to regulate with an entity that doesn't want to be regulated, right? That's the story of humanity, I guess. Like everything, we got to rein stuff in that doesn't want to be reined in. That's how we do it. There's a little thing about Warren Buffett. So I'll say that real quick. I wanted to note this. I saw this little video about Warren Buffett that said Warren Buffett wants 10% of his wealth to go to his family and 90% of his wealth to be put into a specific thing. And they did this whole, ooh, what is that thing? Right? Is it this? Is it the special thing? No, it's just an index fund. It's an S&P index fund. He wants most of his wealth to go into the thing that he knows is going to grow. And when you have a good amount of money, you don't need to make these crazy trades. You don't need to find the next Tesla when you're a multi-billionaire. You just want to preserve in the easiest, safest way possible. So that's what he's doing. He's saying, all right, I'm just going to take a big wad of my cash, put it in the thing I know is going to grow over time, and then it'll be fine. I don't have to worry about I'm going to put it in this thing and maybe one day everyone's going to be rich. No, you put it in the thing and you know it's going to be preserved well, right? If you have a lot of money, bonds are a great idea. You can earn a small yield on that, but if you have a large amount of money, a small yield goes a long way. But if you don't have that much, if you have $2,000, getting 2% on something and 1.5% is not going to give you very much. It's not worth it. You're better off putting that $2,000 into a stock that can move and turn it into $4,000, $10,000, $20,000. So that whole thing was actually kind of an interesting video. I liked it, and I wanted to mention that that's kind of the game, right? You want to get up to a point to where you don't have to play the game anymore. That's my goal. Like, I love stocks. I actually really enjoy looking at them, trying to find things that are going to move. I love the action of earnings season, making a trade, and whether it goes well or not, I love it. But at the same time, I wish I had enough money to where I didn't need to trade like that. I would love to just go, all right, I'm going to put my money in a mutual fund and then move on. Oh, that was the thing I didn't get to with the Stock Ban Act. So the reason I've made a point about mutual funds is because instead of buying individual stocks, they can just move the entire market and buy into a mutual fund that follows the market. They can be like, all right, we want to crash the market. We'll up our mutual fund and then we'll crash the market. Whatever. We got some options on that. Or we want to pump the market. We'll just pump it, take our gains and let it fall. So it's not like they can't do things, but it would just have to be a broader brush now. So forgot to mention that. I wanted to mention that there. All right, now we're getting into the stock. So here's the important point of the show. So I made some trades this week. My number one trade was during the Fed meeting. So let me go to TQQQ, which was my trade. Now the triple Q is a 3x leveraged ProShares QQQ ETF, so the NASDAQ. The reason I picked this is because of the leverage. I wanted to get more movement on it. However, if we go over here and look at the contracts, I was in shorter term. I think I was in these Septembers here, right? Was I in August? I may have even been in August, actually. Yeah, I was in August. So I was in these August contracts, and my strike was the 31 strike right here. At the time, these contracts were just under $200. They were like 190 down to maybe like 170 or 160 at the lowest. So I bought them there, and then I sold them at about 200 something. So I would say I made about a little less than $100 per contract. I bought one early on at 190, right? I FOMO'd into that first candle, which is the exact thing I say never do. When the rates come out, the first 5 minutes are extremely volatile, and it was going very green, and the FOMO hit me. I mean, I've been doing this for years, and the FOMO still hit me, which is why I don't like to make day trades, because that's how you can get wrecked on these things. But I thought, I'm going to miss it. I need to get in. But I know this is probably a bull trap, so I'm just going to get one contract. Just start with one thing. And I did. I got that contract. It went from 190 down to 175 or 170 at the lowest. So it was like, I was down $20. Big deal. And then as it was down, I added. And I added the big chunk right at the bottom of the thing here. So let me go back over to the charts. So now we have a better picture of the Fed, right? So this will be Friday right here. You can see the volume. Thursday, Wednesday. This gigantic volume candle was the Fed. This was where the money was to be made. This is where you normally see it. So you can see the beginning of the day, we had positive earnings. It pumped up, and then it kind of was trending up, but it was staying above VWAP. Anytime it came down to VWAP, it bounced, and it never really even touched it until Powell started talking. So these are 15-minute candles. What time is this? This is going to be 11:30, right? So 11:15, 11 o'clock. So this candle right here, the red one that's got a big wick on each side, when it was going up right here, this is where I bought that first contract. And this is exactly why I say don't get in on that first candle. The first 5 minutes of this whole movement was basically the first 5 minutes. It's after that it stayed more towards the middle. And if you get caught up in that, if you're really FOMOing in, you can get in trouble. But my strategy was to add over time, start with just a little bit, don't go too crazy. And then when Powell comes on, jump in real quick. That's where you actually have to take some risk. So I was not very risk on right here, but once Powell started talking and he said those important things, he said rates are 75, we're sticking with the plan, bond buying is going to be the same, we're going to be data dependent. That came out really quickly. The market started to base. I thought, all right, here we go. It's time. So I jumped in right there heavily. I announced it on stream, and then about 15 minutes later, it started to struggle right here. So I ended up selling. Now, I could have held it and made a little bit more. I mean, this went up quite a bit. But when you're up this much, I was up about 25% at that point, and it was in such a short amount of time, and I had a good amount of cash on the line. I just wanted to get out to make sure things were safe. So that's where I sold. I ended up making 25% from here to here. And it's basically the exact same thing I did last time, but I used a different product. I got in right when Jerome Powell said everything's going to be okay. That's what you have to wait for. It's like, oh, these things are boring. I don't want to watch these Fed meetings. Yeah, well, guess what? Watching it gets you money if you're paying attention. And I was paying attention that time. Everything went exactly like it was supposed to go, which is why I made the trade. Because if you listen to the stream, the whole time I was saying, I don't know if I'm going to make a trade. I don't like the fact that it already pumped. This is seeming a little bit weird. It's not what I normally like. Normally, I want to see a sell-off that's rather gradual, or even a sideways movement until we get those rate movements. But because we had the pump, I thought, I don't know. However, the way the market was behaving, it was staying above VWAP. Every time it came down, it was bouncing. The rate came out at 75 basis points, which was the expectation. So that told me, okay, checkbox number one, rate is what we expected, 75 basis points. That's what we needed. Now, number two, we needed some stabilization after that candle. We got it. It stayed within this range for that half an hour. So I thought, okay, it's staying above VWAP and it's staying in that range. Checkbox number two. Then Jerome Powell comes out. He says, everything is in line with what you thought. We raised at 75. We're going to keep doing what we do, and we're going to be data dependent and see if what we've already done is enough to fix the problem, because it might be. That was it. The traders were in. The shorts were getting out. I took my profit and moved on. Now, if I had held it for a couple of days, could have been really lucrative. However, I did hold the put for a couple of days, unfortunately, so that the put I bought for protection. So I bought some calls, and I thought, I've got so much money in the call side, I should just buy like one stupid little put in case things really go down. Because if you put a bunch of money in one direction and the stock market tanks heavily in another, that is so painful. You think, man, I could have had a put for $10 that's worth like $1,000 right now. If I just bought, I could have wasted that $10. Mine was like 30, so not a lot of money. I thought if that thing gets completely crushed, no big deal. And it did. I lost all that $35 or whatever, which is fine because those calls came up so much. It covered that and more. I've got more cash in my my account now, which was great. Last two Fed meetings, I added some cash to my account. Last time I was able to add enough to buy a few more long positions. This time, I don't know if I'm going to. I think I'm just going to leave the cash that I made for this in my account so that I can trade it. But once this happened, we had a continuation of the move for the next couple of days. So that's important to me. Like the last few Fed meetings have had the move and then they continue to crash or maybe go sideways. This one, because there was so much tension, has continued to go up. Not only was there tension, but there's optimism. Every time it goes below VWAP, it continues to rise, right? We had this little panic when GDP came out, but look what happened. Within a couple of hours, it was back to where it was and continuing. And that's why people were getting squeezed, because as things drop, the bears think, all right, here it is. It's my chance to get in. But all they're doing is adding more fuel to that fire, and the bulls know it. So they're just going to continue to run. They did that, and the next day it went up even more. It kind of trended down for the rest of the day, but Friday was the same thing. It popped up even higher, and it finished higher each of the 3 days. So that's very, very bullish to me. That's why I think this could be the start of a bounce. I don't really know if it actually is going to be a bounce, because it could just be this week relieving the tension and then things continue to drop because interest rates are still up. So that money is still not easy to get. It's not like all the problems have been fixed now that we had the Fed meeting. It's the uncertainty has been relieved, but now the real problems are going to have to come in. And I think the market's going to be blind to that for a while. I think the market's going to continue to see this pump and just go with it. So my guess is that we're going to have at least somewhat of a bull run. Maybe it'll be sideways, but kind of up, or just sideways in general. My guess is that it's just more likely to go up than down. Now, could it go down? Absolutely. I think there's a good chance that it actually does continue to trend down a little more before we bounce, because people want to know what the inflation numbers are. So we're going to be waiting for that, and that is uncertainty, which the market doesn't like. However, people are going to try to get in ahead of the game, and there are going to be a lot more bulls now that we have a more bullish situation. Now that the Fed has pulled the pressure off the markets, that's big. We have not been in this situation for months. You have to think about the 2020, 2021 era was an era of so little pressure that it was easy for the market to just fly upwards. Now we have all these different layers of pressure pushing down, but one of the biggest ones has been removed. That is extremely important. So when you see all the negativity, just remember, this is a good thing. Things could move up. So now I want to get into the stocks because that's what is important right now that the Fed meeting has stopped. So the first trade I made, besides, I should say, the first trade I made was the Fed trade, and that one went really well. But the next trade I made was ExxonMobil. Now, if you look at oil, it's up, right? It's been up for a while. Any company that produces oil is going to be more profitable. And my thought was, this seems like a layup, right? ExxonMobil was, let me go to it real quick and see what it was doing right before it actually reported. So XOM is trending with the market, but if you look at what happened, it went up beforehand because the market was kind of going up, but earnings came out and it just pumped. They beat expectations by a lot. EPS was $4.14, and the estimates were $3.74, so they absolutely smashed the estimates. Revenue came in at $115.681 billion. The estimates were 111.302, so that revenue came in quite a bit higher. And the prior year, it was $67 billion, so not quite doubled, but pretty close. Massive revenue, huge EPS beat, no brainer. I kind of expected that to happen. I thought, all right, ExxonMobil is a good company. So if you're looking at oil companies that are like penny stocks, that's not as much of a layup because their financials aren't as good. Their situation isn't as good. ExxonMobil is basically one of the biggest oil companies in the world. They have amazing resources. They've bought up so many little companies. They don't have as much debt as these other people. They have the best odds of doing well, and they did. So you can see that once they reported, ExxonMobil went up quite a bit. And I ended up selling my calls. I want to say, yeah, it came down and started to come back up. So it was basing in this area for most of the day. I ended up selling my calls right in here. I had some in both trading accounts, which was nice because they both been hit a little bit, so I could use the cash. So that was wonderful. I mean, I thought right here, I bought these things the day before. That's when volatility is super high. Actually, I might have bought them a couple of days before. Maybe I bought them on Wednesday. But it was after the Fed meeting, and volatility for these things was up. But you got to think, like, oil is the biggest driver of the economy right now. It's the main thing that's causing our problems. So if it's that big of a problem for us, it's that big of a benefit for those companies. So ExxonMobil, good company in a sector that's highly beneficial right now, no brainer. Calls all day long. I even bought them on a short time span because I thought, this is going to move up, but the oil companies are so big, you're not going to get like a $20 move, right? People that buy options, they go for, because if you get those $20 moves, that's how you get rich. You buy a bunch of way out of the money options that are worth like $1 or something, and then it moves up past them, and those dollar options become 100 or 200 or $1,000 options. You know, people go, oh, that's how you make the money. But with Exxon, it's such a big company. There's so many shares. It's just such a big market. It's not going to move that much. Most of the people invested in ExxonMobil are big-time investors, people that know what they're doing, people that have studied the hell out of ExxonMobil and all the other stocks. So I knew it wasn't going to move that much, so I wasn't too far out of the money, but it was enough to where those calls tripled, basically. They were very cheap, and they ended up tripling, and I dumped them right into this. I could have held a little bit longer, yes, but I just wanted to get out of them. They were short time span. So if you have any kind of option that has a short time span, you want to get out of that thing as soon as you can. You get any kind of profit from that, dump it. I mean, if you're waiting for a specific event, that's one thing. But if you get any kind of a profit on a short-term option, you just dump it right away. Take your gains and run. So that's what I did with ExxonMobil. Made that nice trade on TQQQ during the Fed, and then 2 days later, a nice trade on ExxonMobil. This was a wonderful week for trading. I've had a couple of bad weeks, so it's nice to have a good one. I mean, Snapchat was a big disappointment. You know, I was really hoping that one was going to surprise. I knew there wasn't really a reason for it to surprise, but when Snapchat surprises, it really moves. Now, that's a stock that could move $20 on an earnings beat or an earnings miss or whatever it is. ExxonMobil, not so much. So that was the first thing. They did really well. The next stock I want to talk to you about actually is WWE wrestling. It's not something I normally trade. I didn't really watch wrestling as a kid. My dad really loved it. I had friends that love it. In fact, I talked to one of my friends that's really into it, and he gave me a bunch of great information, which is awesome. So thank you very much for that. But what I like about this stock now, since I haven't really paid attention to it, but the CEO, Vince McMahon, is stepping down. And the reason is because they were unsure of about $14 million of payments on their books that didn't make sense. They were like, what the hell's going on with this money right here? It's $14 million. It's missing. Well, it turns out Vince McMahon was using that as hush money to pay people not to talk about stuff that he did. Because it's such a big scandal, he has to step down. And he did. He stepped down. So the reason that was bullish for this company is because there's a prospect that it could be sold to somebody that's going to pay more for it now, which actually sounds like a great idea if you are the board of directors. Because I'm sure Vince McMahon was blocking all that stuff. He came in the 80s, turned the things around, so he knows something. He knows what he's doing. But at the same time, he was also blocking a more profitable approach, which is what this pump is telling you right here. Part of it is a squeeze, but part of it's also saying, oh, now there's all these buyers that are interested in it. NBC, Amazon, you name it. They would be Netflix doesn't have anything sport related, so they could pick it up, but they're really probably not going to. But NBC, they have a good likelihood of doing that. Amazon, it would be great for them. There are just so many companies that it would benefit, and it's a very profitable business at this point. So I actually like the prospect of them being able to be sold. So I bought, I think, 2 calls in this thing, 2 leaps. So not a whole lot, but the calls are actually pretty expensive in this thing. So let me jump over here to the trade window and show you what I'm talking about. So yeah, there's a random one I bought in September. That was just like 1 call, right? This one I don't think is going to do anything. I just wanted to have it so that it's in my list and I can add to it later. What I want to get are these 24s. So let me close the September and the August because these are very short time spans. Who knows when it's actually going to sell? It could sell soon, which is why I bought that one random one in September. I thought, all right, just in case it actually does sell early, I'm going to have something so that way I can get at least a little bit of money out of it. But what I'm looking at are these leaps right here. It's hanging out in that $70 mark. In fact, let me go to the chart so you can see it has been trending up for the past few years. Let's see, this is before the pandemic drop. So it had a pretty big drop right before the pandemic. And then the pandemic came in and it was basically already down. So it didn't get hammered all that much more, really. And it started to come back because it was part of the entertainment world, which people needed when they were locked down. During the pandemic, everybody was watching all this content. And so more content was necessary. And if you had content, you had an advantage, which they did. They had content. So they, number one, have been an established business for a while. Number two, they pay a dividend. And actually what is that dividend? I didn't really look at how much that is. So 12 cents for a $69 stock. Not a huge dividend, but at the same time, that means there's still potential for growth. Because when you see these companies that have massive dividends that are actually good companies or long-term companies, the reason they're giving you that massive dividend is because their growth aspect has slowed to a point where they may not be able to grow much anymore. They're going to grow with inflation. Like Coca-Cola is already about as saturated as it gets. Where do you not see Coca-Cola? You can go to some like tribe in the middle of nowhere. There's probably a Coke bottle lying on the ground, like they're saturated. So there's not a whole lot of growth. But with something like WWE, there's still room for growth. And they have been growing every year. If you look at their numbers, they actually have been increasing. So as it's bullish for the stock, now that Vince McMahon is gone, it's even more bullish. This upward trend is looking a lot better. So I like these calls in the 80, 90 range. You can see that it's peaked up there before. If the thing gets sold, it's probably not going to get sold at the peak prices because whoever's buying it wants to get it for a fair deal. I mean, look at the whole Twitter Elon Musk thing. Like the whole reason this happened is because he didn't feel it was worth the 54 billion or something that he was going to try to pay for it. So that he wanted to get it lower. Twitter wanted to get it higher. WWE is going to be the same way. They want to sell as much as possible, but whoever's buying it wants to buy it at a price that still allows them to make money. If they pay too much for it, they're not going to be able to make that money back. The whole reason you want to buy something like WWE is because you think it will be more profitable for you in the future. And the way that happens is if you get it at a fair price. So I think the fair price is somewhere in the range that it's at right now, up to maybe $80. Like the peak, I would say would be $80. Once you go beyond that, I mean, you're getting into such a huge market cap, such a huge PE that I don't know if it would really be worth it for any investor that wants to actually buy it, any entity that has the means to. So I like calls in the 70s or 80s. But guess what? Everybody does, right? Where's the bulk of most of these calls? So there's not a whole lot of volume in the 24 yet, but if you look at, let's see, August right now, so everybody's looking at this. There are a few thousand calls, a few hundred puts. People don't think this is going to drop. That is a good sign. It's still heavily centered around this $70 strike. So people think that it will go just above $70, but look at the volume when you get down to 75. So just $5 later, these numbers right here, you can see 411 open contracts versus almost 2,000 at 70 and 1,000 at 65. So this is where they think the fair value is. So I like these contracts in 24 in the 70s, no higher than 80. Now, look at the spread between these things. So they want $1,000. The seller wants $1,000. The buyer wants $700. So a $300 spread is pretty massive. And that's because there's not much interest in it yet. There are 49 open contracts right there. And look at, people are thinking the exact same thing I am, right? So the short-termers know that this is the price to beat right here. That $70 mark is what they're gaining, they're betting on. By August, they think it's going to be above $70, but they're not thinking it's going to be above 75, right? The volume drops off quite a bit. So that tells me that if you can get in that range and things move, you're going to be good. So if you buy a long-term contract to give yourself time in case it takes months or a year or more for WWE to sell, then you're still good with these long-term contracts. However, I would like to be low enough to where my decay is not as much. Like if you're out here, you're at $100 and time goes on, there's going to be a lot of decay up in these numbers, because as time gets closer and the stock doesn't move, it's less and less likely that it will get to that price, which means the extrinsic value of the option is going to be sucked out of it. So you're looking at options about intrinsic and extrinsic value. Intrinsic value means how much is it worth right now. So these options right here are in the money. The value of these things is a lot closer to what you're actually seeing in the option, right? So if you have a call option at 60, right now you're in the money. So every dollar the stock goes up, you're making quite like $71 or more. And there's a value amount. Like if the option were to expire right now, that $60 call is in the money and it's got intrinsic value. So you've basically got $10 of value as far as the stock goes. If you have the 60, it's at the 70. Your intrinsic value is what it's actually worth. These could be in the money. So they have a lot of extrinsic value because these are January of 2024 calls, which means there's enough time and it could easily get up to these prices. But these ones, if you look down here, the same prices, like $90 is worthless right now. There's like no volume in it. It's like $50 at the most. You'd probably get it for like 30 or 25 maybe. If you actually, because these people want to get out of their contracts, somebody would probably buy it because look, the buyers are at 5, the sellers are at 50. Nobody wants these $90 contracts. They think it's not going to go to $90 in the next 2 weeks. And they're probably right, unless the thing sells. If it does sell, then yeah, it could go up that high and these contracts should be worth ridiculous money. But if it doesn't, then you're out whatever you paid for these, which is why I want to be in these 2024s. The 23 options were decent for a while, but if you think about it, we're not that far away from January of 23. It's getting closer and closer. So I want to have that 24 so I can get more time on that and make sure that I have the time for it to actually be in the money. So I'm looking at these. I've got that little stupid call in case anything happens, but I'm looking at these long-term ones. Hopefully I can get something with a tighter spread. And over time, I might be able to, especially if things go down. But we're probably going to have a pop, so I may not be able to get this one for a while. But I'm looking at it. So it's interesting to me because they could be sold. That is a hugely bullish thing for a stock, being sold to another company. If whatever they're sold at, the stock will immediately jump up to that price. So if WWE is sold for $80 a share, the stock will move up that quickly. And if you own options anywhere in that range, you're going to be happy, which is why I want to get those $75, $80 calls, because those things will actually be worth quite a bit of money. I mean, look at how much these are worth in the money right here, right? This 45 call in 2024 is worth $2,700, over $2,000 for this call right here. So if they're in the money, man, and they're long-term, it's worth it. It is so worth it. So that's another stock I'm looking at. Let's move on to the next one. Walmart. So this was a quick one. Like, Walmart hasn't reported earnings yet. They just did last earnings season, but they early announced and they guided down because they were preparing you for the next earnings season. This is a hugely bullish thing to happen. See this big drop right here? That was because they said, we're going to cut Q2 and fiscal 2023 guidance early. The stock dropped about 10% when that happened. And that's good. But look what happened right after. It crawled right back up to where it was. Exactly. I mean, if you bought this dip, you made out huge. I didn't touch it because I was thinking, oh, well, we've got the Fed coming. I don't really want to do anything, but I should have. Walmart is a very heavy stock. So if you hit it in any direction, up or down, the tendency is to return back closer to the mean of where the trend is at the time. So the stock over just a few days came back that week. So this happened on Monday, or is this Tuesday? So yeah, oh, that was right. After hours on Monday, it started to crash and then come back up right after that. I was kind of sad that I missed that. I mean, I was doing all these other things, so I'm good with that, but this is a wonderful trade. I would have loved to grab that because this is also potential. There's still time for numbers to change in the fiscal 2023 guidance, right? We haven't even gotten to 2023. So if we get through these things, they could guide back up. I like a company that guides down. I'm a little disappointed that it came all the way back because that means a lot of this steam has been taken out. I was actually kind of hoping it would trend down a little more. And if we had still been in the main part of the bear market, then I think this would have been extremely negative and it would have been a great opportunity. Because if you look at Walmart in the long run, they've actually had quite a few movements that you could have capitalized on. They had a nice pump here. They went all the way up from like they were hanging out in the 130s forever. You look at this range, like down and up, down and up. It's like you're just going down the street here. But then they finally took a turn upwards and got to 160, which is pretty high for them. But look what happened in earnings. Got slammed right back down. That was because of the supply guide. Remember, Target did that first, that big movement because of Target, and then they had the exact same problem. So investors were scared, but it bounced because a big movement like this in such a huge company, that needs to be relieved. The shorts need to take their profits and cover. So that's what they did. And it came back down to where it was. And with the rest of the market pumping, it rode it back up. So this negative candle that you saw here, going back to the other chart, was actually a huge benefit because you could have got in on that. But now that they've cut guidance, it's a chance for them to overperform. So under promise and over deliver. Was it UPOD or whatever? That's a good chance for them to do that. But the fact that it came back to where it was makes me think a lot of that steam is out. So I'm not touching it, but I'm watching it for when it does report because that's very interesting. So the next thing I wanted to get to was Sundial, SNDL. Now, the only thing I'm going to say about this is it had a split. So Sundial was trading at like 30 cents until they did a 1 for 10 split. And now they're trading at around $2 because it, obviously that was really volatile. If you can see this candle right before the trade, huge pump and then a drop. And the next day, as the split came out, it dropped and then kind of based down here around 220 or so. So it didn't go up to $2. It just had a reverse split. And a reverse split just means that they're combining for shares. So for every 10 shares you had, you now have 1. It is the exact opposite of a split. Like Tesla is giving you more shares, Sundial is taking away your shares so that they can make their share price look a little better. They're a NASDAQ stock. They are required to be over $1. Any stock that's listed on the NASDAQ has to be over $1. And once it drops under $1, it gets a notice from the NASDAQ saying that you have, I think, between 30 and 90 days to get your stock price up to where it was or to above $1. Otherwise, you're going to be delisted. And if you're delisted, you need to go into the over-the-counter markets like the pink sheets and stuff like that. It's not an ideal situation for a company that's trying to seem reputable because there are so many scammy companies on those over-the-counter stock markets. So they wanted to get their price back up to a point where they're safe. A 1 for 10 allowed them to get at over $1. So now they're at 2. Hopefully they can maintain that and keep themselves above that point. But they had that split. So if you're looking at them and you think they went up and you missed out, no, you didn't. They just had a reverse split, which is what penny stocks do. And that it was an actual penny stock. Like penny stocks are considered anything below $5 now because the money is insane these days. But really the classic definition was anything below $1. And really the original was anything that was actually a penny. But now because things are so inflated, it's $1 to $5. So the fact that they're above that dollar, they're out of the lower penny stock territory, makes them seem more reputable. They're still the same company, but they've combined their shares so they look a little better. And a few companies have done that. GE did that. That's why their share price is up in the double digits now because they were hanging down in the low single digits and maybe they got up to the teens. I don't know. But they're GE. They don't want to look like a cheap company, so they combine their shares. Now, Amazon and Tesla had the opposite problem. They were up so high that people were having trouble buying their shares, so they split them, which gave you more shares if you owned it. And it gave you a way to sell a smaller position, because that was the other problem with having huge share prices, is if you want to take some profits, you have to take huge chunks. You can't just shave a little here and there, because that's what I like to do. When the market's going down like this, I like to put my money into stocks and just get the things that I like at a better price. And then when stocks are going up, I like to shave a little bit here and there. I want to sell like 2 shares, right? I was like, oh, I'll take 2 shares and I'll use that to, I don't know, pay this bill right here. Oh, like I got $100, $150 for registration on my car. Boom, sell a share or two and use that, right? When the market's pumping like it was in 2021. When you're at a point where it's ridiculous and you think, oh man, this is too high, that's when you start shaving things, because the too high will last for a while. It's not just going to end right away. You always think it's going to end quickly, but it doesn't. It continues. So moving on, we went through Sundial. The next thing I was going to talk about was Intel. Somebody actually asked me about Intel last week. They're asking about a lot of the tech companies because of the CHIPS Act. But Intel had earnings and they crashed. Now, I actually made a play on Intel. I bought a strangle, which basically means you're buying a call and you're buying a put out of the money, and you're kind of forming like a barrier above it and below it. So if there's a huge move in either direction, a strangle can profit. But here's the problem. I bought my strangle too far out. It didn't go down low enough. It dropped to 36. I needed it to drop to like 32 or something. And I had short-term contracts on it. So that put that I bought, it actually went down. I bought it for like $20. And even though the stock went down towards the put, it went down $4. So you should think, okay, my put should be up four movements of delta. And delta was like $15 or $10 or something like that. So you should have been like, okay, 4 moves of 10 should be up about $40. That's going to cover those calls that I bought, because I bought calls and puts for $20 a pop. Each individual strangle was $40. So I thought, okay, if it goes down to above $40, then I make some profit on that. It's not going to be a lot because those calls are going to get crushed, but it's going to be enough to make something. Well, it didn't move far enough. I should have been farther out in time, because if I was like a year or two out, those puts would have been up so much. I would have actually been profitable, or at least I would have broken even. But because I didn't have enough time, that play didn't work out. So like all the things going well weren't the only things going on. I ended up losing a trade too, and that was Intel. So my strangles ended up being worth like 20 something dollars a piece. Yeah, barely $20 a piece. So they all went, I lost 50% on all those strangles. So that was too bad. That was the one thing that didn't go well. And the reason that happened was because Intel came in with an EPS of 25 cents and the estimates were 69 cents. So significantly below the estimates. Revenue was $15.3 billion. The estimates were $17.9 billion. So below estimates yet again. They guided down. They got analyst downgrades, 2 of the most bearish things you can get. And the reason was basically the PC demand slowed down after 2 years of strong demand due to the pandemic. I mean, when everybody was at home, they all had to get computers, they had to get devices. People were building machines, so they were trying to get parts. They were selling all kinds of stuff at that time. But now that move is kind of exhausted. People bought their computers. People have that stuff. So people are returning to work. Also, your computer is going to last a couple of years for the most part. So the demand has slowed significantly, and that's what it's showing in these underperforming results. They just weren't getting enough money in to be able to make money sufficiently. And they made less with what they brought in too. So that's very bearish. That's why they dropped. It makes sense. That was the next one I want to talk about. So now another one I want to talk about is Amazon. So I own a little bit of Amazon, so I was very happy about this. They had a good quarter. They ended up with an EPS of negative 20 cents with the estimates of positive 14 cents. You go, wait a minute, why is that good? They didn't do well. That should be a bad thing. Well, their revenue beat estimates. They came in at 121 billion and the estimates were 119 billion. They guided up for Q3, which overran the whole missing the estimates on the EPS part, because they brought in more money, but they made less with it. So you think, oh, that's actually extremely bearish. So this is why you have to pay attention to more than just the numbers, right? Because people that first get into trading, they think, all right, I look at the numbers, there are estimates everywhere. You can find out what the basic consensus is and just see if they beat it or not. Well, that doesn't matter too much. They can really miss the estimates, but come through with something that makes the shareholders happy. Right? Like one of the big reasons they lost so much money was because they put a huge amount of money into Rivian, the electric car maker, because they basically want to be able to have an electric fleet, hopefully save some money, make things more efficient down the line. But Rivian's dropped quite a bit. They've lost $2 billion in that investment so far, which is not a small chunk of change, especially when you're a company like Amazon that still is losing money, right? Like they do, I think they have positive quarter. I haven't been following Amazon as closely until recently because I actually wanted to buy the shares. And now that I buy the shares, I actually pay attention to them. But I don't know as much about the past. And from what I understand, most of what they do is not profitable, but the profit comes from their Amazon Web Services, and that was another positive thing. So the estimates were that they were going to bring in $19.5 billion of revenue for their Amazon Web Services. Well, they brought in 19.7, so they beat the estimates on how much money was coming in for their extremely profitable arm. So that was bullish as well. They also got a ton of analyst upgrades, and the price targets were between $150 and $200. Well, if you look at it right now, it's sitting at $130, so that price target is quite a bit above. In fact, if we go to the longer term chart, you can see that the price targets are actually close to where it was before it fell. Because Amazon had that really bad quarter last time, and I was talking about that. I said, when you see a drop that big in a company that good, there's a huge potential for a bounce. Not to mention the fact that they're weighted heavily into the market, so whatever the market does is going to reflect in Amazon. And that's part of the reason why we got this pump. But the main reason the pump happened was because Amazon guided up and they got analyst upgrades. And they said, hey, our profitable side of the business is doing much better than expected. Yeah, we didn't do as well on EPS, but we pulled in more money with revenue. There's still room to grow in the internet sphere. If you think about retail doesn't have as much room to grow because it's been the king forever. But now that the internet is challenging that, and Amazon has taken a huge percent of the market share. They have like 20% or something. Like online, if you take all the online retailers and put them together, it's only like 20% of all sales. So there's a huge amount of room to grow. They could become a much bigger company than they are, and they're already massive, which is one of the reasons why I wanted to buy them. And they're also heavily investing in new ventures that are probably going to be profitable. Not all of them. I'm sure some of them will crash because Amazon has a reputation for buying things and having problems with them, but they also have a reputation for doing certain things well. So I like the fact that they're the biggest and they have room to grow, which is why during this drop, I was buying some shares. After this happened, I thought, ooh, it's finally the time to be able to get into Amazon. So I got in during this mess right here, and I think I added during this mess. So Amazon's looking really good right now. They missed the numbers, but they guided up and they got analyst upgrades, and that's all that matters. That's why you see that massive pump. Boom. When you see a level change like that to where it's instantly just up at a different level, there's a lot of support under that. I mean, it could drop back down slowly, but because we've had this big level change and there's a future that looks better for Amazon, I think we're going to probably hang out or continue to go up as long as the market is positive. So that was another good stock. The last stock I wanted to talk about was Apple. So Apple also reported. Amazon and Apple, they reported on the day of the Fed, I believe. Was that at 1-2? Or maybe they reported right after the Fed. It looks like there's only 2 days of volume for Amazon. But I think Apple, AAPL, this is looking like 2 days as well. So, but I thought they reported on the day of the Fed announcement. So anyway, it doesn't matter. They had the same kind of thing. So Apple, their EPS came in at 120. And the estimates were $1.16. So they were a bit above the estimates, which is good. The revenue came in at $82.9 billion, and the estimates were $82.8. So they did beat it, but not by much. See, the reason these estimates are so close is Apple is one of the most watched companies in the stock market. So there are a lot more analysts crunching the numbers, way more than some of these other stocks. So the consensus on these estimates is generally a lot closer. Now, Apple does surprise quite a bit, just like any other company does. It's very difficult to be on, but I find that the analysts are a lot of times they're close with Apple because Apple is a heavily analyzed stock. But yeah, so they beat EPS estimates, they beat revenue estimates, they guided in line, which is good. That's bullish. They're not raising guidance, but they're saying, hey, everything's still on for what we were saying before, which is extremely bullish because that tells you they're not being affected by things as much as people feared. The iPhones and revenue services were up big, but Mac and wearables were down a little bit. iPhone revenue was up about 2% year over year, and Mac and iPad demand is more cyclical. iPhones are more stable. So you got to think Mac and iPads are kind of going in with the Intel problem, right? People bought a bunch of computers during the pandemic, and now they're not buying as many computers because, number one, they already have them, and number two, they're going out more, so their focus is back to their phones. And phone demand is always strong because your phone is a necessity these days. If you work in any business, you're either going to have a phone or you're going to have access to a phone because it's just that important to make sure everybody has information right now. So iPhone sales are steady. They're a huge company. They're in as many countries as they can be. So they're selling a whole bunch of smartphones. They're expensive, and it continues to go. Strong demand. So Apple did well. If you have Apple, which I don't, and one day I will, they're on my fantasy stock portfolio. So one day I'm going to own them. But if you had them or you had a trade to the upside on them, you're doing very well. Apple options would have been a great play on this one. But everything was uncertain, so I didn't touch it. So that was the stock portion of everything. We did really well with a lot of these earnings. That ExxonMobil trade was great. The TQQQ trade was great. Intel wasn't as big. It wasn't too bad for me, but it was a little bit of a loss. So the other thing I wanted to say about Apple is they were actually having problems with currency exchange. Like one of the things that hurt them is they weren't able to exchange at as good of a rate. The stronger the US dollar is, the harder it is to turn other money into US dollars. So let's say you sell a bunch of things in China using the Chinese yuan, right? But you have to then convert that yuan back to US dollars in order to get everything on your balance sheet. And the exchange rate is up because the dollar is more expensive. Oh, I missed a comment back here. I'm sorry. Sloan Fishby, I'll judge Amazon by the new Tolkien series, right? Yeah, there you go. So you got to see their content is a huge portion of what they're going to be doing going forward. Streaming is huge. So yeah, Amazon definitely got to see what they're doing with their content too, not just everything else. But the last thing I wanted to say on Apple was actually one of the other reasons why this went up, and this is actually kind of an important point. So if you're paying attention to short selling, this whole thing with Snap was actually really interesting. So Snapchat, one of the reasons they dropped so much, they reported last week, actually. Let me go back. We'll just take a look at them real quick. One of the reasons they reported terribly was because they had problems with advertising. Right. And that's where they make a bunch of their money. I mean, there's a subscription service, and I think there may be some other things that they do, but mainly they're selling ads, like a lot of these companies are, and that's where they're getting a huge amount of revenue. As long as their users continue to grow at a good rate, then they are a stock that looks good, which is why they pumped all the way up here to the 80s not that long ago. So less than a year ago, it was up here at $83. However, they didn't do well with their ads, and they basically told short sellers that, hey, all these companies are going to have trouble selling ads. So anything that's somewhat advertising related got shorted heavy. You think Amazon's got some ads, Google's got some ads, Apple, they've got ads in the App Store. They've got ads in the actual Apple stores on their displays. News app, and they have a stock app. Those both sell ads. Not to mention they have a deal with Google. So Google is the default search engine in their Apple products. So they've got some money there. So people thought, ooh, they get a bunch of money from ads. I'm going to short them. Well, that's a mistake because that's only one piece of their revenue. Apple is such a complicated company. You can't just look at one section and say that's it. I was talking about that before. People are short-sighted when they're looking at stocks. They think, okay, this one thing, right? Like that was what it was. A while ago, it was monkeypox. There was somebody that made a trade on monkeypox vaccines because they saw the news coming up early. The pandemic was fresh in their mind, and they thought, all right, got to jump on this right now. But monkeypox is not the same thing. It doesn't spread in the same way. There are way fewer cases at this point, so it just dropped because they thought, oh, a monkeypox vaccine, it's going to be necessary, but they're not going to sell as many as they did with the COVID vaccine, right? The COVID vaccine is just a huge amount of sales, whereas monkeypox, not so much. So people made a one-sided trade on that, and the problem was they were trading in companies that also had other things going on, and they got crushed because number one, monkeypox didn't show up as bad as COVID did, and number two, their other product got crushed, which crushed their whole trade. You got to look at that, and that's the same thing that happened with Apple. People looked at Snap, they went, okay, Snap had trouble with revenue. Apple's going to say they're having trouble with revenue, and it's going to hit them hard. So they shorted, and they were wrong. They got squeezed. They got squeezed on Google. They got squeezed on Apple. They got squeezed on Amazon. All these companies that people were so bearish on went up big because there was so much negativity surrounding them. So I thought that was interesting, actually, and it's something to pay attention to. They're still going to do it. Okay, like the shorts that are looking at these things are still looking at companies for a chance to sell some premium or to short shares because they think, oh, one of these companies has to have a problem with advertising, right? They're not done. They don't learn their lesson from the first one. They get squeezed and they just go in harder until they decide they're going to be done with the market completely. So anything else that has ad revenue and it's a big chunk could be looking at another squeeze. But here's the thing. If that ad revenue actually isn't good, like Snapchat, they could have a problem. In fact, has Pinterest reported yet? I can't remember. See, Pinterest would be another interesting one to do because they have movements like Snap, and it does not look like they have reported yet. So I don't know when they're reporting, but this is one of the stocks I want to watch. Yeah, they've been level for quite a while. The earnings brought them down, but they've been sitting in the teens for months now, right? So when was this last? This would have been in April. So ever since April, they've been in this range right here. This is insane. All right. This company follows the social media sector. They're in the social media sector. So if there's a pump for any reason, Facebook, for example, I think they may have already reported, but there's just so much stuff going on. Oh, they're Meta now. That's right. I forgot about that. META. I think it should just kept FB. It's easier to type. Yeah, they reported. So they're out of it right now. They probably had the same issue. I actually didn't look at them because so much stuff was going on. Normally, I would watch Facebook, but it didn't really do anything. So this would have been an iron condor type situation, which I don't know if I would have put on because lately the sector's been so volatile. I don't know if I want to do that. So, but in the end, it would have been a nice play. However, I didn't see it. I was looking at so much other stuff. There's just so much stuff going on right now. You're not going to catch it all. And that's the kind of the point of the season right now. There's just too much to do everything. So the best thing you can do is just sit back, take a breath, and look at the things you know, right? There is potential everywhere, yes, but put all that stuff aside and focus on one thing. Who cares about this? Who cares about that? Just look at the thing you know you can make money on, or you have a good feeling you can make money on, and focus on it. Right? You don't have to put all your eggs in one basket or anything, because I did multiple trades. I did the Exxon, I did the Intel, I did the Qs during the thing. So many different trades going on. Plus, there's WWE. I'm doing Snapchat long term. I've still got my long account that I'm adding to. There's a lot to do, but I focused on the things I knew I was going to do well with. And that was number one, the Fed meeting, which was the big trade of the week. And number two, ExxonMobil, because they were pretty much a layup. They looked like they were going to be. There was just too much to get. And Facebook wouldn't have been anything good for me anyway. So even though I kind of wish I had been able to trade it, there's too much going on to do that. So let's get on to the next thing. We've talked about stocks. Oh, the last thing I wanted to say. So there was somebody, Cryo QT or whatever. I said, hey, come back next week. I'm going to have some more information on 23andMe. I actually did some research into 23andMe, and it's been really crushed right now, actually. So let's go to it real quick. ME. People feel very strongly about this stock too. So that's actually another reason why I like it, because there is controversy around it, which can lead to high volatility. And if you look at this thing, it's extremely low. It IPO'd last year. It had this little bounce, and it's just been trending down ever since. There are reasons to buy this thing, right? It has an extensive client database with 80% actively participating and consenting to data collection, which is something they can sell to companies. I mean, data is like the number one thing right now. And if you think about genetic data is even more important because there's so much more room to grow there. So they have this nice client database that's consenting to them selling the data. Now, with what the moral implications of that are, that's a whole nother story. But for the stock, that's a positive thing. So the other thing they did is they bought Lemonade, the telehealth company. I remember hearing about that a while ago, but I didn't pay much attention to it because I thought, whatever, Lemonade, they're a newer stock. I don't follow them. But it was a good transaction for them because they brought in the some of the board of directors. I think the CEO is still managing that section of it. They were doing well beforehand. They were a good company to buy. So that was extremely bullish for them. They retained some of Lemonade's team to work on part of that business. The thing that I really like about it, though, it has a partnership with GlaxoSmithKline. They started that in 2018, and they renewed it recently. Like I think in February, they renewed the contract until 2023. That'd be at that point 5 years of the contract. The thing I like about it is whatever drugs are developed by this collaboration between 23andMe and GlaxoSmithKline gives 23andMe 50% of the profits. So they provide the genetic data. That's all they have to do. And they give that to GlaxoSmithKline. And GlaxoSmithKline has to do all the hard work of making the drug, going through trials, seeing what works and what doesn't. And then 23andMe, eventually, if things go through the pipeline, get a chunk of the profits. That is a wonderful partnership. The other thing I really like about them is they have a bunch of cash on their balance sheet, like a ridiculous amount of cash. It was hard to go through all their stuff because they have this huge 10K And I saw that they have the cash, right? And I was looking at the debt, I was looking at everything else, and I wasn't seeing where these hundreds of millions of dollars came from. I'm assuming a loan, I'm assuming a sale, something like that. I have to do more research on it. But the fact that they have a ridiculous amount of cash, they have like 3 times the amount of cash that they have liabilities. So if things went completely dead right now, they could pay everything back and still have 2x that amount of money left over. That's wonderful, right? For a penny stock, that's extremely rare. Now, the downside is they're hemorrhaging money still. They're not a profitable company. Their genetic testing section, just the like, hey, let's look up ancestry, that portion has been slowing and it's not as profitable. The thing that's profitable is the drug discovery and selling the data. That's what's making them money right now. So they do have some problems, but for a penny stock, that's extremely interesting to me. So I ended up buying a couple of long-term calls because they could be down for a while. In fact, even Kramer was talking about, he said something like, I think the risk is priced in at $2. That's weird because it's been going down. Like the negative news came out early and all this stuff was adjusting to it, right? But now that it's been adjusted to, between 2021 and 2022, they picked up like $500 million in cash. So that's extremely bullish for this company. They're GlaxoSmithKline is a big company. It's an established company. They're in good health. They have a partnership with them. They just bought Lemonade, another good company. They're in a sector that's continuing to grow and could be monetized in other ways that we don't know right now. So to me, this is an interesting penny stock. Now, I'm not saying like, oh, this is something, it's going to go up definitely, and this is the thing to buy. Like, I don't give recommendations to buy or sell anything. I just give you my opinion on stuff, and you make your choices. For me, I've been thinking, hey, this looks like an interesting thought. So I bought a couple of long-term calls, a couple of leaps, not that much, just a couple $100. So those things are going to be good for a while. And at $2, there's not a whole lot of downside risk. So I'm not worried about those calls with the amount of time and the level the stock's at getting destroyed. I think there's more upside than anything else. And this is, somebody came on the stream and just asked me about it. You know, I had casually thought about 23andMe, but I have so much stuff that I pay attention to. I just didn't want to I didn't want to use brain power to try to do it because I barely have enough to go around as it is. But now that I've been looking at the stock, I'm like, this is actually kind of interesting. What you want to do, if you want long-term growth, you need to find something that's beaten up enough to buy in when there's a bottom. And is this the bottom? Maybe. I don't know. It looks like it might be a bottom. There's a potential for it to be a bottom, but that doesn't mean it necessarily is. You know, especially if we have more downward movement in the market, then yeah, it's going to bring the stock down even more with it. That's just what happens. The market sells off. But the fact that it's stayed at this teen level or this 2 level for quite a while tells me that it might be at a bottom. So buying calls have very low downside risk at this point. A good amount of time, a nice factor to go up, because if those calls, I mean, those calls are at like $5 or something. So if it just goes up to here where it was before, those calls are going to be in the money. And if it goes up to where it was not that long ago, I mean, those calls are going to be deep in the money. I'll probably add to it. If the market brings things down, I'll probably add some more. If this trades sideways for a while, I'll add some more as well. The other thing is we're going to have earnings coming up at some point. Let's see, when are they reporting? So they're reporting on the 8th. That could be an interesting time. If they get hit even harder on earnings, I'm going to buy some leaps heavily in this thing. It has potential. And you know, companies like this that have potential and are completely beat down don't come along very often. So this to me is an extremely interesting one. Now, I could be extremely wrong about this. You know, I've looked at companies before and been like, oh, there's a ton of value there. But the one I'm referring to specifically was relying on a deal that never went through. Right. So that's the thing. When you're speculating on something that could happen, there's a difference between that and speculating on something that is happening and speculating on real fundamental value, which there is in this stock. Now, because they're hemorrhaging so much money and because one of their biggest sections, the genetic testing for ancestry thing, is kind of sinking, yeah, there are some worries that things could go down, and they may not find any drugs. GSK may not be able to do anything with the data they give them, you know. But I've been seeing a lot of genetic based health stuff coming out lately. There are people that say, hey, you know, we can run your genetics and then find out what foods work best for you, what exercise routine works best for you, what sleep cycle works best for you, what drugs you might be allergic to or not allergic to. I think there's potential for that to actually work out to something. So to me, this seems like a valuable company, but it's thrown down so much. Let's see, how many shares does this thing have? 450 million shares. Not bad. Not bad. I mean, that's a little high. I'd like that to be a little bit lower, but it's not in the billions. right? So to me, that's not a huge float. The other thing I wanted to look at is, let's see, go back over here. I want to look at the short interest. So I did this the other day, and the short interest, 13%, not bad. That's a high number right there. So there are a lot of people shorting 23andMe at these lower levels, which tells me that earnings, if they even come anywhere remotely close to the numbers, could cause a squeeze. They don't have to be perfect. All they have to do is say, hey, things are doing okay here. They can pump up their GSK deal. They can pump their lemonade thing a little more, and that could squeeze the shorts. So I like this one for a bounce at some point. I don't know if it's actually going to do anything. It's a chance for it to panic again at earnings, or more likely not move. But it's also a chance for them to pump. So I'm actually looking into this one. That was a good suggestion from CryoQT. Hopefully you ended up coming back. I don't think you did. If you end up watching this video later in on YouTube or something like that, that was a good suggestion. So I like it. I think it's something that's worth looking into. Like I said, though, you have to make your own decision. So only get something that you think is okay. Like, never take a recommendation. I say this all the time. I have never taken a recommendation that worked. I've had like 10. I've gone, I'm probably around 10 trades that have been given to me by either someone I know or a YouTube video or whatever, some guru. They've never worked out. So make sure you are sure about this trade and you like it for other reasons. Do your own research. Like, make sure, no matter what your financial knowledge is, do your own research. That's extremely important. Just become knowledgeable enough to look at the basics, right? Because a lot of times the basics will tell you all you need to know. Look at the assets and liabilities. Look at the news surrounding the company. Look at what they actually do. If they have a store you can go into the store. Make sure it looks decent. Talk to the people there. Are they happy working there? Does it look like they have enough product? When they do these earnings calls, are they saying, hey, everything's going well, we're able to get things? Are they talking about their struggles? Are they making excuses? Like, just look at the basic things, and I think the earnings call for 23andMe, I'm going to listen to that because I want to hear what they actually say about everything. The conference call is going to be extremely interesting for that. So if you end up watching this again, thank you for the suggestion. Very cool, CryoQT. Probably never see you again because that's how Twitch goes. It seems like, somebody comes in for a week, they're super excited, and then I never see them again. That's just kind of how it goes. Okay, so we got through the stocks. So I was going to talk about Plug Power a little bit, but all they're doing is benefiting from the Inflation Reduction Act. They also report their earnings on the 4th, so I want to watch them. It's still kind of tentative, though, so it may not even be the 4th. Another stock to take a look at, not even going to worry about it. Okay, so let's move on to crypto and then close this thing out because I have to get going soon. So crypto is basically following the market. It has been pumping. Let me go to /BTC. Let's take a look at the Bitcoin futures and what they're doing right now. Look at this pump. We're getting a little pump, right? It came down here to 18 at the lowest, and for the past few weeks, it's been going up. I mean, we've got, let's see, this is red, but 1, 2, 3, 4 weeks of, possibly 5 weeks of upward movement, which is kind of the same with the stock market, and it's following the market like it does. So I don't even worry about the stories coming out in the cryptoverse anymore unless it's something big, right? So crypto is something that is so heavily tied to the market now, you can just watch the market and know what crypto's doing. But you still have to look at it because it does move slightly independently sometimes. And I think once the market comes back, there's still excitement for it, and it'll probably pump again. So this pump up to 24 has been nice. It's been nice to see my portfolio move up a little bit, but it's still nothing. Like, if you're really looking at it, it's still kind of within this range that it's been trading in, and it's sort of hitting the top of it. It's maybe a little bit above that range, thinking about moving out. So that's a little bullish. The fact that it's sitting towards the top of the range, maybe even above the top of that recent range, but it's still kind of hanging out. So we're just waiting for things to clear. So SEC Chair Gensler says too much of crypto lacks fundamental safeguards, and they want to regulate it. What do you know? The SEC wants to regulate crypto. What else is new? Everybody in Congress wants to regulate it. The SEC wants to regulate it. The CFTC probably wants to regulate it. It depends upon what it ends up being classified as. So that's what some of these other stories are talking about, right? Okay, so Coinbase, right? You may have heard that Coinbase has an insider trading case going on. One of the very important people in the company was caught buying their tokens before they were issued. It's like, all right, this week, this token's going to be issued, so I'm going to buy a ton of it. And that's insider trading. That's obvious insider trading. So that person's going to get crushed. I don't remember what the name is. I didn't write it down in here, but it's one of the main people at Coinbase. But they're going to get in trouble. And here's the interesting thing about the case. This is why I'm even bringing this up. So the SEC says 9 of the 25 tokens in questions are securities and should be prosecuted like a stock. Coinbase says it doesn't allow securities on its platform. So that's the fight right now. Is this cryptocurrency a security or not? If it's a security, then it's bound by the rules of stock, which means they can be prosecuted as it would if it was a fraud with stock, which means it's going to come with a lot more penalties. So this is a very important case, and it's not the only one. There's another class action lawsuit filed against the Yuga Labs for the losses occurred during the Bored Ape Yacht Club pump. Right? Those NFTs were worth a ridiculous amount of money and they came down. In fact, there was so much air in those things that people got wrecked on NFTs more than other forms of crypto. Number one, because it was newly in the public eye, even though NFTs have been around for years, the public really wasn't aware of them until this pump in crypto. During the last big pump in crypto, NFTs weren't huge. People weren't talking about them, so they didn't get much of a spotlight. But now that they are in the spotlight, there was a chance for people to get wrecked on them. Now, this Bored Ape Yacht Club was very popular, so a lot of this stuff I think is just based on the market. Yeah, it sucks that people got wrecked in this, but you also have to realize when you're buying something like that, you're buying into a huge bubble. Like, you should understand the risk of those things. And a lot of people don't. That's why they have these laws in place, because most people don't study stocks and don't study investments. I'm obsessed with these things. I'm looking at these things all the time. I'm looking at the rules. I'm looking at what they do. But not everybody does that. Other people have lives to live and they need to do their thing. So they're just going on the hype and they can get crushed like that. And things like the SEC are trying to protect against that, but you can only do so much, right? If you lock things down too much, then you don't have the market that's friendly to people and people aren't able to participate as well. But if you don't lock it down any, then scams run rampant. So you have to find this balance between that and everything else. The big thing is, are these things securities? That's all these lawsuits are talking about, that because that's a huge difference. If they're not securities, the penalties aren't going to be as severe as if they are. And it also means the trading of these tokens is going to have to change if they end up being securities. That's why Coinbase is saying we don't allow securities, because they don't want to deal with the problems, with the headaches that come with regulated securities. So they're saying none of these are. But the SEC is saying, hey, 9 of these tokens in question that this person bought behave like securities, so we're going to classify them as that. Now they'll have to convince a jury that they're securities, and Coinbase will have to convince a jury that they're not. That's what we're waiting for. And that's interesting. So that and the Bored Ape Yacht Club are going to be 2 important trials going forward. There's not a whole lot of talk about them right now, but to me, those are 2 of the most important things in the crypto space, because that will tell you what happens with crypto. Part of the reason it's down is because people are worrying about this regulation. These lawsuits are weighing on the people that have money and know what's going on, and the market is just pushing things down even further, so people that don't even know about it are getting crushed. And when this kind of stuff floods through the mainstream, when the trial actually happens, if it ends up going badly for Coinbase, then that's going to be all over the place. That's going to push the crypto market down quite a bit, because it means other security or other tokens are now going to be on the chopping block to find out if they're securities. So this is huge in the cryptoverse. And this could also be a buying opportunity. If everything comes out that they're not securities and everything's fine and the guy just gets charged for basic insider trading, then that's not going to matter too much for the markets. It's like, yeah, this guy took advantage of it, and he needs to be punished for that. It's just what happens. But if they're not securities, then that's going to be extremely bullish on the market pump. So I wanted to bring that to the stream here. The last thing I'm going to say before I get to the ending section here is Celsius. The lawyers, now this is interesting to me. So the lawyers at Celsius, which, went insolvent and locked up everybody's money, the lawyers say that the platform's users gave up their rights to the coins they deposited in the borrow and earn programs under the e-terms of use. As such, their lawyers say Celsius is entitled to use, sell, and pledge or rehypothecate all of those coins as they see fit. So basically, Celsius is saying, sorry, we're not giving anybody their money back because by the terms of service, you agreed to leave it with us if there was a problem, which is extremely scummy, in my opinion, and why I don't like a lot of these crypto exchanges, because you can get trapped in these things. That's what's happened. Everybody that put money into Celsius now is looking at the possibility that they're not going to get it back. Now, this is just the stance taken by the lawyers of Celsius, and Celsius is trying to do what's in their best interest and not have to pay as much money as possible. But the people that deposited money with Celsius want to get their money back. And the government, or I should say, places like the SEC and the CFTC and all that, they're going to be trying to get people's money back. Insurance is going to try, if there was a type of insurance that covered that, which I don't know if there was. I don't think FDIC definitely didn't cover it, but SIPC, I don't think that covers it either. So I'm not sure if there was insurance behind these people's money. That's another reason why I didn't want to get into a lot of these crypto exchanges, especially the small ones, because what happens if things get locked up? Are they going to lock my money up and then have lawyers try to tell me that that's not my money? Well, that's what's going on right now. So that's another thing to look at. So the two things that are important, number one, are these token securities? Number two, are these people able to lock up your money and do what they want with it if there's a problem, right? If everything's going good, there's no problem. Everybody's making money. But when things aren't going well, that's when you start having these companies locking up people's assets. And if you put most of your assets in there, you're in serious pain right now. I only put in what I can lose, but a lot of people don't. A lot of people are extremely irresponsible, and they put like 90% of their money into this thing thinking like, all right, I'm going to ride this crypto up to millions of dollars and I don't ever have to work again. It's like, if you get in at the right time, yeah, that's going to happen. But if you come in when the crowd does, you're not going to make that much. And you'll probably ride it into the ground because you won't sell in time. You don't know what you're doing. You haven't been through this. You don't know when it's time to take profits. 2021 peak, time to take profits. Anywhere in that last half of 2021 was time to take profits. Even if you took them 6 months before the end and you missed all that, you're still way above where you are now. So that's what you have to think of. Like, put your money in, you get some gains, take your profits when you get them. Don't be greedy. If you're up big on something, just take the money. Yeah, it's going to suck if the thing keeps going up. That happens all the time, but it's better than losing it because you feel awful when you lose it, especially if it's too much to put in. So with me, I'm okay. I'm just putting in the money that I'm okay losing. But with some people, they're not. So these court cases are going to be extremely important for the crypto world. There's general regulation coming in Europe. People want to regulate it in America. So that's another reason why crypto is down so much. However, these headwinds could subside and things could move up again. So I'm liking the possibility for crypto, but I'm buying extremely slowly because all these prospects worry me. If this SEC securities thing ends up going in the SEC's direction, then there could be some problems. So I don't want to be too heavily invested in that just in case. But when tensions are relieved, crypto's going to fly. Crypto is one of the most volatile things on the market. I think artwork is like the only thing that beats it in terms of volatility, or maybe it even matches it. But that's the thing to be in when we have a huge bull market, as long as crypto has the ability to reign free. So I'm keeping an eye on it. I'm adding to crypto very, very slowly, not putting too much in. I'm getting it on brokers that aren't centered around crypto, like I'm buying it in my Robinhood. So just something to keep an eye on. The crypto market looks interesting. So we talked about stocks. We talked about the macro environment. Basically, what we're looking at for next week is earnings season. Earnings season is continuing. Let me bring this. Here is my list for next week. We have quite a few companies on the chopping block. We're in the heart of earnings season. This is traders like me. This is what we live for. This is when options are volatile enough to actually make good money on. So this week was great. I don't have quite as much confidence in the companies that are reporting next week. Like, I guarantee you there are going to be moves, but I'm not sure like which way they're going to go. Right? AMD is coming up. I think AMD actually has a chance to be really bullish. AMD has already gone up with the market, but they've come down so much, and they have that CHIPS Act that went through, which they're going to mention in their conference call. That's going to be bullish for them. So my guess is AMD is looking good to the upside, and I own shares in that, so I'm probably not going to play it. I might maybe get an option on it, but because it's already up and I own shares, I don't know if I want more long exposure. Like, you have to weigh how much exposure you have to any individual direction, right? If you have a strangle on with options where you have both directions as your move, your enemy is stagnation. You don't want it to be flat. Any big move is good for you when you have a strangle. If you have long shares, you just want upward movement. If you have short shares, short calls, whatever, you just want downward movement. So with AMD, I'm exposed only to the upside. And I don't know if buying protection to the downside is going to be the way to go, because the premium on these options goes way, way up when when their earnings happen. So like the days leading up to the earnings release, those are the worst times to buy options. I mean, I did it and it was successful last week, but I did it for a reason. Like, the reason I bought those Exxon ones was because I expected them to do well due to the macro environment. But AMD, they have a chance to do well. They're at 94 already. They could go over 100 a little bit maybe, but I'm probably not going to play it. So Alibaba, there's so much trouble with Chinese companies right now. I'm not going to touch that one. However, they are down, so I'm looking at collecting shares for the future, because I had Alibaba. I bought it down here and I sold it up here. which was nice. But I'm not going to trade them on earnings. I'm going to use earnings as a way to see what goes on. I might actually, I might buy a couple of shares before earnings, but it's not going to be a lot because my cash has dwindled. Now, Beyond Meat, that's an interesting one for me. I don't like where it is in the range that it's been trading in, but Beyond Meat moves big like Snapchat. It's one of the ones that can move on earnings. If you look at this last earnings report, there was a big dip and it rebounded because it's extremely volatile, but it's still staying in this range. I had some calls on it while it was going down here. I unloaded those calls because they were short term and they didn't do very well. I didn't buy back in, or I should have held a little bit longer, but this one was kind of crushing me, so I'm not as into it. It also doesn't have as many prospects. Like they had the McPlant with McDonald's. There's a collaboration there, but that trial is over. So I don't know if they're going to continue it or not. If they do say they're going to continue it in their earnings call, then it's probably going to be bullish for the stock and it could jump. But that's depending on something that may or may not happen from another company. So I'm not going to count on that. I'm looking at the premium on this thing. Premium is ridiculous. Let's look at the close contracts, right? The 19th. Look at how expensive these are. Going up to 41. It's like $100 for the 40 for a contract right there on a stock that's been hanging out. If we go out even farther in time, like I usually like to buy at least 2 months out minimum, but I prefer like a year or something. We could do the February of 23. It's not quite a year, but there's not too much volume. They're sort of expensive. You want to get the 55 for $200? Maybe. I don't know. It's not terrible, but it's not that great. The long-term ones, though, if you get into 100, see, at 2024, paying $150 for the 100 strike, that's not bad. I could do that because that one, these aren't too bad. But when it moves, the premium jumps like crazy. So these weeklies, actually, these are going to be, no, these are the right ones. These weeklies that are gonna expire during their earnings week. Like, look at this. These are so expensive for out of the money is expiring in a few days. I don't really want to touch these because I don't know if it's going to move, but it has been an interesting one to watch in the past. So I'm going to watch it. I'm just not going to do much on it. So the next one is Avis or Cars.com. I'm sorry. That one I'm just going to watch. I don't know much about it. I'm not going to do too much. Caterpillar. Now that is an interesting company. They're reporting. The thing is, though, home sales are down. Construction is going to be down a little bit because of it. But we've got all these bills going through the Senate that are moving money around. So there could be a need for these things. It depends upon where that money goes. But I don't know enough about it, so I'm probably not going to trade it. I will watch it, though, because it's one of the big companies. I believe it's a Dow company, so it's a huge mover of the market. Canopy Growth. I am in Canopy Growth heavily. And, of course, I'm doing terribly, as you can see, because I've been buying in on this mess. I sold in the teens, right? I had a bunch of cannabis stocks, and I sold them in the high to mid-teens, and I started buying in at the low teens. My average is like 12 or something on YOLO, and YOLO's at $5. So it's painful right now. At Canopy Growth, I have a bunch of long contracts. I could have unloaded them here on this pump when they initiated the legalization bill that either already got crushed or will get crushed. And I didn't take it. I thought, all right, let's ride that. But nope, it went down. Now they've introduced another bill. So it's possible that things could move forward with them. So my calls they're basically dead in the water. There's some value in them, but I'm not going to take that out. I've lost so much in those. I just need to leave them. It's not worth taking out what's left because if it comes back, I'll be pissed. So I'm just going to count that as lost. Like my cannabis play has destroyed me this year. That's been the one thing that's been rough. Like I've been doing well with trades, but investments obviously have been going down, so I can't really make a judge on those. But my Canopy Growth long-term swing trade has been awful. Just cannabis in general has just been murdering me. So I am going to keep an eye on Canopy Growth. I'm rooting for them because if they go up, my calls are going to come back a little bit and a bunch of money will bleed back into my account. So I'm hoping for that, but I'm kind of doubtful at this point. Really what we're waiting for is that legalization bill. That's the big thing in the cannabis world right now. If that gets through or even if it looks like it could pass. See, that's the ideal situation for me. It looks like it could pass. The cannabis sector pumps and I'm able to dump. And then it either does or it doesn't pass. If it doesn't pass, I've got my money and things continue to go down and I could use it as a buying opportunity for more long-term cannabis plays. That's why I'm buying the ETFs. Like I'm buying YOLO, I'm buying MJ, I'm looking at some other ones. I'm just trying to pick up the whole sector because I don't know who's going to come out on top in this thing. So that's another one reporting. Clorox, big company. I'm not going to do anything with them, but they're going to be interesting. It's good to see where they're their stock is. CVS, I'm not going to touch this one. I don't know enough about them to do anything. Caesars, same thing. I just wanted to see what gambling was doing because there are some bills on the docket in my state for some legalization of online gambling companies, right? The casinos are fighting this. The local casinos don't want it because it's going to cut into their profits. So there's kind of a battle going on. So I want to watch these gambling plays like this one, MGM, DraftKings, that kind of stuff. Because they're going to be interesting coming up. I mean, there's a lot of legalization for their services in places that it isn't legal now. So that's interesting. Yeah, definitely going to watch that, but I'm not going to trade it. Dash, I'm not going to trade that. I'm just watching it. EA, same thing. I'm just going to see gaming hasn't been doing well, but EA is okay, so I'm not going to worry about it. eBay, probably not going to do anything with that. Robinhood, I own some Robinhood. I've sold most of it when it pumped, luckily. So that was a good trade for me. But I like if this whole payment for order flow thing gets solved, Robinhood's fine if they keep it going. If they don't, then they have to find other ways to make money, and Robinhood stock is going to tank even more. So it's at a point where I'm like, I don't want to be heavily invested in it, but if it runs, I'm going to be mad that I lost it. So I am looking at buying it back if it really, really drops. But I got to know if their money making ability is going to continue. That's the important thing. I'd like to be early on this thing, but I just can't afford to waste money on something that I'm not sure about. So I'm looking forward to Robinhood earnings, but more as an information standpoint than an actual trade. So industrial power products, I used to own this. I dumped it up here somewhere. I would like to maybe eventually buy it back. But I'm probably not going to at this point, so I'm just watching it. iRobot, it's another one I kind of watch sometimes. They have these drops. MicroStrategy, see, that's going to be kind of in the crypto sector because Michael Saylor, the CEO, is heavily invested in crypto, and their business is heavily invested in crypto. So that'll be an interesting one to see, but I'm not trading it. Cloudflare, I want to see the security space. I'm not trading that either, but that's interesting. New Gold, that's just a stupid company, the gold mining company that I found when I first started trading, and I have this like nostalgia for, so I kind of watch it sometimes. It goes between like 50 cents to $2. It's in that range all the time. It's never going to break out of it. Well, I mean, it might, but it's mostly going to stay in that range, so it's not something I worry about. Oh, good REIT. Going to watch what happens with that. It's up towards its highs. Salome Fishby made a nice little trade on that one, actually. He was telling me in the Discord, so congrats on that one. Very good trade. Look at this chart. I really like that. O's a good stock, though, so it's good. It's worth owning as well. You could... If it drops, it'd be a good one to pick up again. So maybe you can play both directions. Who knows? So Occidental, another petroleum company. Now that's what I'm interested in. It got a little bit of a pump because Exxon did. Anything in the sector with a company that does well, that's heavily weighted in that sector, will cause the other companies to move as well. No surprise there. This one I might, if we have a red week, Occidental Petroleum is a nice call buy opportunity for me. But I don't know if we'll have to see what happens. So I'm waiting on that one. That's kind of another good one I'm waiting for. So like AMD, Beyond Meat, Canopy Growth, and Occidental Petroleum are ones that I'm looking at heavily. So the last few, Plug Power, those earnings are tentative. We don't know if they're going to be on the 4th. I just want to see what they're doing. I don't really have anything on them. Starbucks, they've got a lot of controversy right now, but regardless of what they do with their unionization, they're still going to be a profitable company. So if they get hammered, I used to own Starbucks and I sold them. I bought them in like the 70s and sold it around 100. So I really wanted to get in again, but it's like I'm spread so thin right now, I don't know if I'm going to be able to. They would really have to drop. If they can drop back to this like 50, 60, 70 level, I would love to buy some more shares, but it's probably, I don't know if it's going to happen. So watching Starbucks, want to see what happens, looking for an opportunity to get in someday because I kind of missed this one and just too much stuff to get in. Skyworks Solutions, they make some of the stuff for Apple, like in the phone, some of their chip manufacturer, so I'm looking at them, their earnings, just to see what's going on in that sector. They're probably going to be somewhat positive because of the CHIPS Act. You had another one to look at. Let's see, Uber. I'm just seeing what's going on with Uber. I don't really trade that one that often. And Yeti, same thing. I'm just kind of looking at it. So most companies I'm not really paying attention to. These few I'm kind of paying attention to, but the big ones are definitely Occidental Petroleum. Let's see, go back up here. Canopy Growth, AMD, Beyond Meat, possibly Alibaba, but that's kind of a different story. Robinhood. So those are the ones that I'm looking at mainly for next week. And there's still a lot of earnings. Like if we go to the calendar here, we see how many people are reporting on these days. You can see next week there's 200 on Tuesday, 150 on Monday, 270 on Tuesday, 460 on Wednesday, 670 on Thursday, and 120 on Friday. My gosh, this is probably one of the heaviest weeks of earnings season altogether. So I went through all of these companies and looked at what I was interested in looking at, right? What am I going to actually monitor? So that took a long time to do. That's the down part about earnings season. There's a lot of research you have to do. You have to spend a lot of time in your off hours just going through news, going through reports, looking at filings, making judgments on things. It's exhausting, to be honest with you. I love earnings season because that's when I'm really active. You know, for the past couple of months, for the past like month or so, I've been pretty much inactive waiting for this time, and now it's time to go. So that's what I'm looking at right there. So next week, that's basically what we're looking at. Earnings. We've got a while to wait for data, more economic data to tell us whether or not the world's going to end. Spoiler alert, it's not going to end. We're going to be fine. Even if things are rough, we're going to be fine. The hype is always overdone. So don't be afraid of all this negative stuff you see. Just brush it off. Try to keep your mind clear as possible and move on with your life. Just know that we're going to be fine. It's a way to be secure. If you got a lot of anxiety, that's one thing you can let off of your anxiety. It's the fact that we are going to be okay. The worries, think about how many worries you've had in your life. What have you worried about your entire life? Different things, right? How many of those things have actually come true? Some, yes, but most of them didn't. A vast majority of the worries never came to fruition. And that's how life works. That's why there are inefficiencies in pricing in the stock market, because people are overly bearish on things and they overdo the selling, or they overdo the shorting, or they put negative news out there. They're going on to every site they can, telling everybody how bad some stock is. That's just life. It's not as bad as fear. So grit your teeth, do what you got to do, talk to your financial professionals, make the decisions you think you should make, but do them calmly. You know, really take a breath. I'm serious about the whole breathe thing. It's very important to make sure your physiology is calm and relaxed. And if you just take a few breaths slowly, in and out, through the nose and mouth, all that stuff, you'll feel a lot calmer. You'll be able to make some trades. Like right now, taking a breath. I was really hyped up for the stream, but I'm calming down a little bit. So I need to get going. I appreciate everyone staying here and watching these streams. I am now going back to what I said before every other week. It's just trying to do these short streams is just too much work. People come in, they talk, the streams end up being longer. Last week's was supposed to be 10 to 20 minutes max. It ended up being an hour and a half. So I am going to do every other week. I need time to make content. I have other stuff with life. I can't be doing it every week. It's just too much work. So next Sunday, no broadcast, no short one, nothing. I'm going to do content. But the Sunday after that, I'll be back. Every other week, a Stockalypse is going to be here, looking at these stocks, giving you his opinion, making sure you are set up with the knowledge to make your own decisions, right? That's what's important. We all need to be able to make our own decisions. We can't rely on everybody. It's good to work with people and work as a team, but you need to make your own decisions. So remember that. Be safe. Be careful, make your own decisions. And as we go out, I want to give a couple of shout outs. So there have been a couple of streamers that have been amazing to me. Dirty Old Socks and Celestius07. They're both EverQuest streamers for the most part. They do kind of play some other games here and there, but it's mostly EverQuest. They've been awesome. They've given me shout outs. They've played clips from my my stream. They've gone to my YouTube, liked things, pumped all my stuff. I really appreciate it. So check out Dirty Old Socks and Celestius07. Give them a like, give them a follow. You know, check out their stuff on YouTube. Celestius has some music that's really good. She does some DJ stuff. Dirty Old Socks is funny, but you know, make sure you're not offended easily. You know, they definitely, it gets dark in that stream sometimes, but it's funny and it's fun. They do a lot of interesting stuff there. And if you like MMOs, you know, if you've never played EverQuest, check it out. It's basically the game that got all modern MMOs to where they are today. Everything kind of ripped off EverQuest, you know, and then EverQuest kind of ripped off everything else later once things changed. But it's still an interesting game, and it's fun to talk to these streamers. I really appreciate all the shout outs they've given me. You know, they're excited to see me when I come into the chat. They talk. You know, some streamers, it's difficult, but they've been really cool. So thank you very much for all those shout outs. I really appreciate it. Anybody that's going, check their streams out. All right, I got to get going. I appreciate the shout outs to all these different channels. Check out Dirty Old Socks and Celestius07. Also, make sure Sloan Fishby, he's got a channel. He plays Spinnerlands. Go check him out. You know, give him a follow and sub to him and all that stuff. make some awesome content. He also got some cool sci-fi playing. I love turning on his channel and just listening to the sci-fi. Even if I'm not watching the games, like if I'm doing other work, it's just relaxing to hear that. I mean, that's what he's got going. He's got a really good thing going. Also, Barbarian Blast Machine. Hey, thanks for all the info. I appreciate you coming into the stream. Thank you for being in the stream. You've been here for a few weeks. I really appreciate that. It's been cool having all you here. So I'm going to get going. Have a good week. Not doing a whole lot, just watching the earnings. Be ready for what's coming up, not next week, but the week after that. It's going to be very important. We'll see what earnings do. And if I make enough trades to actually be profitable and get my account back to where it was before, can it be growth? All right. I'll see you guys later. Have a good weekend.